So as Ethan had prompted when we were talking before the show, there's a force in the universe called compound interest. And yeah, I know your eyes are just bulging there. But if you start saving early, you have decades in order to compound returns that are potentially 5-10% per year, especially if you invest in equities.
But welcome. Good afternoon, evening, whatever the heck it is, where you are. Thank you for coming in. Wow, today is going to be a hell of a stream. We're going to have a lot of people. We're going to have me, we're going to have Devin, Nash, we're going to have Brian Weller. Brian Weller is a professor of finance on leave from Duke, who is also head of data science at Twitch. So we're going to have like a he's, you know him here from chat. He goes by Think Banhammer and shows up as staff sometimes, both in my channel and with Devin.
Brian, I'm going to ask you some fucking hardcore questions, bro. Because, like,
we should start with who he is.
Go for it, man.
Question. Yeah, but like, I want to, like, even before that, like, that's like the prehistoric times, okay? Like, I feel like one of the biggest problems and one of the most common things that I get in my community is people asking, just what the hell do I do with my money? What is this current state of finances? And like, how do I be responsible with it? And people take this subject very seriously. And I usually answer like, well, I'm not a finance dude or a registered person, but you can take my really bad advice and then maybe lose everything that you have. Invest everything you have into Bitcoin. I don't know, like, right? So Ethan and I were discussing this problem, and Ethan's like, we should really do a show about finances. And originally, Ethan and I were going to come on and talk to you guys about this with our, somewhat limited, slightly educated, but mostly limited knowledge of financial discipline.
That's right.
And then Ethan managed to find like the fucking Doctor Strange of finances. And that's this dude right here. Who wants to intro? You want to do? I can do it if you want.
No, I'll take it. So right. Brian Weller, also technically known as Dr. Brian Weller, is at Twitch, works at Twitch. He's in our chat, both of our chats. You know him as Think Banhammer with his staff wrench. So he hangs out with us. He is also head of Twitch Data Science, technically director of Twitch Data Science. And there he is in chat as Think Banhammer. Further, he is on leave after 7 years in academia. He was most recently, I always mix them up, assistant and associate. But he was one of those two A-word professors. Oh, wait, that sounds bad. At Duke. Someone, by the way, offered me $100 to make a Duke joke, and I'm not exactly sure how to do that. Like,
don't take bribes, Ethan.
I don't. Well, is that a financial strategy? No bribes. In any case, if I knew how to make a Duke joke, I probably would. Prior to Duke, he spent several years at Northwestern's Kellogg School of Management, if I have that right. And then prior to that, where was your actual education? I'm working all from memory, not from the list. So I'll let you take over, Brian.
I have actual show notes.
I'm impressed. So in those prehistoric times, as at UFC, so I went to U Chicago for a dual PhD between the economics department, business school, and finance. And before that, I was at Harvard. I got a degree in applied math and economics.
All right.
Damn, dude. Well, like, that's really crazy. How old are you?
Like
too old, man. 33.
Is he on the way? Why would that be?
He was just considering. He's not delayed. He was just considering whether or not he wanted to answer that, I think.
Are you delayed?
No, there is a delay here.
Why?
Probably about 3 seconds, yeah.
Why?
Must be something in Zoom. I'm not sure.
No, it can't be. Because Ethan would have it too.
Yeah, I don't have it.
Yeah. We should figure that out because that's going to be very annoying. for everything.
Yeah.
Do you have like a firewall?
Reset this call. We can drop the call and come back.
You can. Because you're the only one with the problem.
I'll do that. Yeah.
Cool. Yeah. All right.
All right.
Yeah.
So, yeah. So for folks in my community, I always use the question extension. If you want to throw questions in there, we may get to those later. For now, we'll focus.
How
just on the
soon?
chat.
How soon did you hear this? Oh fuck! My guess is it's an internal gateway problem with Twitch. What was that? It's still doing it 100%.
Because something on the Twitch side, I suspect. Simon, Twitch HQ. Yeah.
Archie, you're the director of data science, right?
Yeah, data. The data tells him it's delayed.
I am.
Can you figure it?
That's actually super weird.
Look into it. I'll ping someone and see if someone can fix it.
Oh shit, we got a guy for that.
Yeah.
Yeah, because it will actually affect a lot, right? Because we have to.
It's like we're talking to a guy on the moon, but if you want an expert at that level, maybe that's appropriate.
Maybe he's on the ISS and he's doing like experiments on like maybe he's moved to the ISS because of coronavirus, and he's the only person left in the world who can predict the financial markets, so they moved him to the space station to make him safe.
That might be true. Yeah, in his introduction, and in completing his own introduction, he didn't talk about the fact that he has in fact worked on high-frequency trading, as well as studying the first flash crash in the commodities market. So
pretty cool.
Yeah,
in treasuries. So in treasury futures.
Treasury futures. Okay.
Why
flash
not just
crash
use
in treasury futures?
Because the video function is fucking ass for it. We can try it if you want. Zoom is always better for this stuff. I guarantee you. I have done dozens of Zoom calls and it's always been fine. I guarantee you it's some Twitch thing that they have. It's like, no, you got to go through the firewall. It's something like that, dude. Yeah.
But those don't normally, I agree with you, but they don't normally introduce delay. Like that's really, firewall wouldn't.
Do you want to try Discord?
No. I mean, we can if you want. That'll be I would prefer not to do that. I'd prefer.
It would take 15 seconds.
That presumes user error on this end. The last time I tried to capture a Discord window and bring it in, it didn't work. So I gave up.
Oh, that's right, because we have to account for your boomer setup. Okay, I got it. Okay, all right, I got it.
Why don't we just roll with it?
Okay,
and he'll have the tech support squad coming in a second, I suspect.
Send in the squad.
Yeah, hit up the general Slack and we'll see what happens.
Holy shit! Well, you'll definitely have plenty of people if you do that.
I don't know what that means.
All right,
Twitch stuff.
So, Devin,
hi.
What are your questions? Like, why don't we decide how we want to frame this? Because we invited people to talk about personal finance. But of course, since we came up with the idea of the show like 3 weeks ago, the whole market has changed. We had the fastest correction from all-time market high to 10% decrease in the history of the market post World War II. We have we have instability presumed to be around presidential elections. We have coronavirus fears, and that's all just the market. Personal finance goes a lot beyond Wall Street, right? It's what do you spend? What do you make? How much?
I mean, all right.
Yeah.
Look, we've got the finance guy here. Let's cut to the brass tacks. Brian, how do I get rich? No, I'm kidding. Okay. But I do want to paint a picture. I do want to paint a picture for the expectation that the vast majority of people have for this show and how to provide value through it. And if you keep that in mind through the whole thing, I think it's going to be amazing. Which is essentially that we've got a lot of people. Demographic is 20 years old to 35-ish. There's probably like 2 people in here that are 35. Most of them are coming up with some kind of profession that is not investing and not economics and finance, right? And they want to know and ask us how to implement best practices in their financial life to have a discipline that is sustainable and scalable for their future. And I think if we approach this show with that context, I think we will add a lot of value.
Good. Appreciate the prompt.
Okay, so from that,
Good.
yeah.
So yeah, go ahead.
This delay's gonna fuck with us. No, you always talk over me because everything you have to say is more important than what I have to say.
Yeah, throw politeness out the window and roll with it. I agree with that.
Mm-hmm.
We want to hear you because you're the expert, and then we'll throw questions in edgewise.
Yeah, I'm a dude. Also, this is a very random question, but are you listening to the stream and not the Zoom call?
I am listening to the stream.
That would explain it.
Why aren't you listening to the Zoom call?
Let's see if this fixes anything.
Yeah, that the Zoom call's in real time. It's
Hold
the
on.
stream delay. He's listening to the 3-second stream delay. That explains it.
There we are. Hold on. Yeah, the Zoom call's not piping through the audio.
All right. Yeah. All right. Look, Devin can debug remotely. Give that man a gold star.
I didn't think it because it's so okay. It's like, all right, we're cool. We fixed it, boys.
All right.
He's got to figure that out. Yeah. So on the bottom left, there's going to be a microphone button, and
on the bottom left of Zoom.
Yeah,
Yep.
and there's an arrow. You pop it up. It says select a speaker. Pipe it through your headphones. Dunzo.
Yep.
Mm-hmm. This is why Twitch.
Uh-oh.
Okay, the whole general Slack can't figure it out.
My chat wants me to hire you as an SDE, Devin. What do you think?
I don't know what that is.
Software development engineer. They're saying since you can sort out microphones, we need an audio guy. Or
I will consider the
woman.
CMO position or CEO position for Twitch, though, if you want to put me in.
They're full at the moment, but if they become available, I'll let you know.
Yeah, you let me know if Emmett plays too much Hearthstone. I'm on it.
Yeah, we'll give a referral for you.
Okay, thanks. I'm the dude.
Sweet.
Wait, is it real time now?
I think so. What do you think?
Oh, fuck, that's it. Yeah, you did it. You did it. Oh, I'm so excited. Oh, my God. Okay.
Much
now
better.
We got a show.
Now we're on. That's right.
Now we got a show. All right.
Sweet.
Okay, so with that context, yeah.
Fix.
I think we should start
Go.
with what?
I said go.
I'm going. We should start with
Faster, Devin.
All right. We should start with the coronavirus is catching up, dude. We gotta go faster. I think we can start with personal discipline and finance, if that's valuable. Or dude, you're the finance professor. Where should we start? You teach this shit.
This is for individuals, though.
Yeah.
Personal finance. Where would you begin?
Yeah.
Where would I begin? I begin thinking about savings over one's lifetime. So as Ethan had prompted when we were talking before the show, there's a force in the universe called compound interest. And yeah, I know your eyes are just bulging there. But if you start saving early, you have decades in order to compound returns that are potentially 5-10% per year, especially if you invest in equities. So the first
equities?
Stocks.
Okay.
Stocks like U.S. common stocks, things that you'd buy or sell, things that you see on TV, like Microsoft and Amazon. Of course, not speaking on behalf of Amazon or Twitch for anything I'm saying today.
Me either.
Yep. Me neither.
Yeah. So the simplest advice is to have a simple budget tracker. So think about what are your consumption needs, what are your consumption desires, and what are your savings needs in order to prepare for retirement. So there are some common rules of thumb like 50-30-20 for needs, wants, and savings. You need to find the rule that works for you, but saving early rather than waking up when you're 50 and looking at your account and finding it empty, that's something that you need to think about. This is not deep advice, but it's the first advice that I'd give to anyone who's in their 20s.
So one of the things is that compound interest is the whole idea of like making money and compounding that money is based on the theory that the markets have always gone up, right?
No, it's not. So first off, you could invest in treasuries. So treasuries, they might pay 2% year over year. And that can compound. That's virtually risk-free, at least in the US. You can do fancier versions of this. You can do international diversification and all sorts of yield curve plays if you cared. But basically lock in, say, 2% per year. Or you could think about stocks. Now, for stocks, depending on what window you're looking at a premium of maybe 6% over treasuries year over year. That's on average. So that's going to be something like 8%. But the volatility of stocks, as you note, is pretty big. So there are some big up years. There aren't so many big down years in the US, but there are a few. 2008 comes to mind. 1929 comes to mind. There are even a few months like October of 1980, 89, or 87 that jumps out. But typically, the return for US equities is large and positive. You'll hear me flip between equities and stocks. I'll try and keep it to stocks. It's large and positive. If you have a long horizon, if you're talking about decades, investing in stocks is a fantastic idea. At least in the US.
Obviously not specifically, but like when you say investing in equities, that is a very wide range of things. So somebody could take that and say, okay, I'm going to invest in Microsoft. Someone else could say Amazon. Someone else could say, right? So like when you say invest in equities, do you mean just shoot darts at a board? Do you mean invest in an ETF? Like what?
Yeah, absolutely invest in an ETF or a broad-based diversified mutual fund.
So
ETF, what is an ETF?
Exchange, yeah, thank you.
It's an exchange-traded fund. So think of the S&P 500. What's the S&P 500? You've probably seen the S&P 500 on TV. Maybe you look at the Dow. You have some index of a lot of big companies. So Dow 30, it's some of the biggest companies. There's some arcane weights. But the S&P 500 is pretty easy to understand. It's the top 500 largest U.S. companies. And it's weighted based on market capitalization. So big companies like Amazon, about $1 trillion market cap, at least until last week. They get a big weight. Smaller companies get smaller weights. So this is an index of 500 stocks. Now, you can buy each individual stock in the index, but that's extremely expensive. So no one in reality does this, at least no individual investor. So instead, we either take a mutual fund that is designed to track an index. So this is an asset that you could go to Vanguard. You could buy a mutual fund. They have broad-based indexes. They have an S&P 500 index. And you can just buy the thing. Or you can buy an exchange-traded fund. Now, what's an exchange-traded fund? Exchange-traded fund is a claim to an index that's actually traded on a financial market. Okay. So it's going to be traded exactly like a stock. You can buy it, you can sell it at will. There are tax reasons why you might look at a mutual fund versus an ETF. But broadly, they give you diversified and cheap exposure to a large set of stocks.
Brilliant. So did everyone understand that? So what he's saying is there's a thing called an ETF. That means it covers a big part of the market. You put your money into that. It gets you across a bunch of different stocks. So you don't take the risk in just one. And then over time, that should perform well, right? And we'll make more money on top of the money that's in there.
Yep.
And so, yes, Ian.
I was just going to say the advantage. So if you invest in a single stock and you pick brilliantly, you will make more money faster if you happen to pick a great stock. So at some point in the past, for example, I think Red Bull was the most ascendant stock in the last 10 years at one point in time and had gone up 24,000%, something absolutely mind-blowing. But it can also go down to zero. In an exchange-traded fund or any index, you have a basket of hundreds of stocks. You're not going to get the wild up or the wild down.
Mm-hmm. So there's a really easy way to compare individual stocks and indexes that makes clear why you should typically invest in an index. So when you think about, for most investors, what you care about and what you want to avoid, you care about high average returns. So you like it when something pays 3% versus 1%. You like it when something pays 10% versus 3% on average. But most people want to avoid risk. Now, we can go into, and I'm sure we will shortly, what sorts of risk there are. But most people don't like taking on excess risk. So if you look at an index, something like the S&P 500, the amount that typically moves year to year, its volatility is about 15 to 20%, depending on what decades you're looking at. If you look at individual stocks, An individual stock's volatility could easily be 50% or even 100%. Now, you're not getting compensated for that additional risk. Is the same average return as the index, typically.
So,
yeah, go ahead.
When it comes to loss, okay.
Yep.
The example that I try to use is if you have $100 and you invest it in a stock, and the stock gains $50. So you had $100, you make $50. Now the stock price is $150. Okay, you have one share, right? Then you've made 50%. But if you have $100 and you lose $50 and you're at $50, you need to make 100% back to get back to normal.
That's right.
So most sound investing strategies, right, are dependent on not losing money versus making money. Everyone thinks that making money is like number one thing, but you want to not lose money, right? Like, is that correct method of thinking?
Yeah, that's about right. So if you want to be the richest person out there, if you want to be the next Jeff Bezos, what that means is that you need to hit a lot of home runs and you need to make a lot of long shots. So then you're going for the riskiest bets, typically, to be the richest person out there. Or you work for decades after decades after decades. But if you want to be an extreme on one side or the other, you take massive risky bets. Now, most folks want to cut off the so-called left tail or the bad extreme, in which they lose everything and they lose it early. So for the typical investor who's thinking about retirement at some point in their lives, I would advise against investing all of your money in these extreme bets where you could lose 50% in a year, because clawing back from that is hard. You need to double.
So, a couple questions on that. Can you talk for a minute about one of the things we didn't talk about with an ETF is you're not paying a transaction, but you're not paying a load. So you haven't talked yet, and I'm about average return of the S&P, and then the cost that can go against that. Because if you're going to take the slow and steady wins the race approach, which you're recommending, and I think many people agree with you, then the difference over time of a 9% average annual return versus 10 versus 11 compounds to freakish amounts of money.
Yeah, it's absolutely massive. And the easiest way of thinking about it is, suppose that you had, instead of the stock market, you have some asset that pays 1% every year. You have some stock that pays 1% every year. Now, the average active mutual fund, so a mutual fund that tries to outsmart the market, the average mutual fund charges 1% per year. So if they are investing in this sort of asset, every year, they're going to give you 0. Now, that's not a good deal for you as an investor. So if you look at something like ETFs, or if you look at something, what's so-called passively managed mutual fund that tries tracking an index, they have much lower fees. So instead of getting that 1%, now you're getting 0.9%, but 0.9% per year is a lot different from 0% per year. 0% you never grow. 0.9%, eventually you will. Now you can shift that and talk about 7% versus 8%, but the same sort of logic applies. You'd rather not pay these large fees associated with investing in active mutual funds, or God forbid, investing yourself and going in and out of the market.
Okay, so what he's talking about here is something called an expense ratio, right?
Yes, that's part of the fees.
Yeah, which means it's basically the fee that it costs for you to actually invest in this thing. And let me like just tell you the majority thinking right now that we need to work with in the context of this discussion. Okay, so a lot of people, what they do is they go to Reddit or they go onto Twitch or whatever. They see people making huge plays into options, and they see people making short bets on Tesla and making $80,000 in a day. And then they put all their money into Tesla and expecting to have some huge plays. And so the meme is, you go to like Reddit, you see people doing well. And when I'm actually talking about this to my community, one of the most frustrating things is everybody is telling me that they're getting into options. And they're taking what's called leveraged bets, which means you're taking a bet with a certain multiplier, right? That your thing is going to do well. can you speak to this? Because that is a very large amount of people that think that's a good idea.
Yeah, so I'll break that down to two parts.
Yeah.
The first part is they're effectively making a volatility play. So there's a part of it where they hit the lottery, and then there's most of it in which 90+%, they lose everything that they invested.
There you go.
Now, you can talk about, you can do fancy tricks with options to move that risk around, but these are effectively lottery plays, and hedge funds play that way too. They just move the risk into corners that it's hard to see. The other part that I'd mention is I'd like to generalize this point. A lot of people think they can beat the market, much like everyone thinks that they're better than the average driver. It's no different. Only 50% of the population is better than the median driver. So if you're better, that means that unfortunately someone else is worse. And in financial markets, the folks who are better at it are the Goldman Sachses of the world. They're the Citadels of the world, large quantitative hedge funds. They're sophisticated investors that do this professionally for their job, not the random guy you see on the internet. So if you want to trade, understand that someone's making money in trading, and it's probably not going to be you. That top 20% is going to be dedicated to the Goldman Sachses and the Citadels, and then you're more likely to be in that part that makes Goldman Sachs rich.
So what you just said is, if you can't spot the chump at the poker table, it's you, right? That's
exactly right.
And everyone thinks that they're not that guy. Everyone's like, I'm the guy that's going to beat it.
That's
so
right.
Yeah.
Interestingly, though, do not the large funds have? I'm actually going to take the opposing view for a minute, and you'll either educate me or everyone else. The large funds have certain constraints on them in that they are driven because investors can enter and leave those funds. They're typically driven to try to show quarter over quarter numbers, which is a bad. So they have to balance the tension of what they know is the best investment strategy with what they know looks good to their investors on a short-term basis. And that actually can cause the large funds to trade suboptimally. What's your perspective there?
Yeah, that's a great point. So we can contrast among different types of institutional investors.
Please.
So you can think about the mutual fund that's down the street that advises mom and pop. And this investor makes you feel real good about investing money in them with them because they tell you a good story. They take care of you. Now, those sorts of investors operate under a few different sets of constraints. One is exactly as you mentioned, Ethan. So the constraint that if they're catering to mom and pop and you show them a bad quarter in which they lost 10, 20%, it's hard to reassure mom and pop that their money is actually protected.
Correct.
So they're operating under this sort of constraint that they need to market effectively their performance.
Yes, exactly my concern.
Yeah. So another type of institutional investor, and I'll get to the second sort of constraint in a moment. You can think about hedge funds. Hedge funds don't have to worry quite as much about that, in part because they have lockup periods. They have institutional features that make it so that they don't need to generate high returns every quarter. Or we have mutual funds that are passively managed, that it's no indictment of their skill if they don't perform. It's just how the market did. So again, you're not trying to justify your performance in the same way. You don't have to worry about the money running away from you. So these sorts of funds perform better because they don't need to worry about so-called liquidity risk or some sort of flight risk of the money that's invested in them.
But the standard funds available to the average person in like a 401k tend to be the quarter by quarter retail funds. Is that correct? I see you nodding. I don't want to lead the witness. I'm just honestly curious.
So when you say quarter by quarter retail funds, I at least think you have our 401ks, and I don't think there's anything proprietary here, but you might think about Vanguard or Fidelity.
Yeah,
or
the big providers of retirement funds, Vanguard, Fidelity, etc.
And these funds are not trying to spin a story for us. They have components that do. So if you wanted an active manager within Vanguard, that's a service they offer now. But the default, the typical option is you just invest in an index and this fund provides you that index for cheap. So I don't think they need to worry about liquidity in that same way. And these massive mega funds that you're talking about, Ethan, like the Vanguard Total Stock Market Index, they have very sophisticated liquidity management so that when a set of investors leaves, they don't need to worry too much about servicing flows out. They have plenty of cash set aside. So they're pretty much immune to this.
Okay.
But the other constraint to think about is what sorts of investments they can make. Most mutual funds are very limited in how much they're allowed to short. So Devin, you had mentioned that word earlier. Shorting, you can think of as taking the opposite side of buying an asset. So there's some borrowing logic to it. But the idea is that when you short something, you profit when it does badly, and you do less well when the asset goes up. So mutual funds are often quite limited in their ability to short, which constrains their sort of investments that they can make on your behalf. Now, if you want to be just a broad-based, diversified investor, maybe it doesn't matter. But if you're looking for more sophisticated risk exposures, mutual funds often aren't going to be the vehicle for you. You might want to figure out, how could I get access to, say, a hedge fund replicating index or some sort of asset that lets, or asset class or management class that lets you short and do more sophisticated movements of your money.
Okay. If I'm a normal human worm baby, how does that apply to me?
Yeah. In terms of being able to short or go into a hedge fund?
No, in terms of just being able to do anything with basic personal financial discipline.
Yep. So basic advice, generally mom and pop shops are those that are charging you 1%. And it's much cheaper to get the same source of investment without the story through something like Vanguard or Fidelity. So if that's offered through your...
Okay.
So like walking into your retail bank when you're... let me make this really concrete for someone. First, we haven't yet talked about, in order to invest or in order to retire, you actually have to spend less than you make. The money has to come from somewhere. So we'll come back to that maybe because it's about personal finance. But like step one, you've got to earn more than you're spending or you'll have nothing to invest. So we can come back to that. I know, like, super basic, but while most people watching this stream or many people watching this stream do that, most people actually don't. Like, most of America spends everything it makes every day, every week, and is in debt, and then often is in high interest debt as well, none of which we've talked about. So table that, we'll be back. But the point is, what happens, like, if you start having money in your bank account, your bank, if you go into like the counter or whatever, they train their tellers to like look at your savings account and basically be like, you have 2 pennies to rub together. Would you like to talk to one of our bankers? And that's where they start telling you this story. And banks are generally for profit. And so I'll let you pick up the story, Brian, if you want. But like, what happens at that point when a banker, what happens at that point when they notice you've got $10,000 in your bank account? And are those good investments to make?
Right. This is one of those instances in which if you're not really spotting the opportunity, you are the opportunity. So if you go into a bank and they're offering you something, some financial
quote.
product.
That's a fantastic quote. I've never heard, and I will remember it. Go on.
You go into a bank, they're offering you a financial product. They take commissions on that. So there's an incentive structure, and this also applies to many mutual funds and asset managers that you might run into as a normal worm baby, Devin. They don't necessarily have to act in your interest. So they're offering things that they get a kickback for, and or just a direct commission for selling you a thing. So is that what's best for you? Probably not. Now, I can't speak for all banks at all times. I'm sure that some look out for their customers in a different way. But when I think about where the low-cost investments are for accessing the highest risk to, or highest reward to risk assets,
Oh, wow. The Zoom meeting just collapsed. I don't know what happened there. I hope it was general. If there's someone also on Devin's stream, let me know if it died over there. I'm going to go figure out what happened. But we'll get it back here in a second. Zoom is always awesome. He says it died. We'll have it right back. We can pull this off. So when we come back, I'm going to see if we can talk about fiduciaries, because this meeting is not valid. That's not good. Shucks. Hang on. All right. He gave me a new link, and he says he'll explain. He fat fingered it. He killed it. I don't know what happened. All right. Join the video.
Hey, we have a slight problem.
Okay.
I
lost you. No audio.
When for meetings above, is it true? Is this how it works? For meetings above 2 people, I think Zoom kicks you off after 45 minutes. Is that true, guys? Free calls on Zoom have a 45-minute only for 3 or more people, right? Because I just talked to Maya for I talked to Maya for 4 hours yesterday on Zoom, and I talked to Quinn for fucking 7 hours on Zoom. So I think it's only a 3 people meetings. Is that true?
So if that's true, I mean, we can just fake it. It'll die twice more. We'll know what to do. So what? Right?
40-minute on group stuff. Yeah. Or I could just switch to another thing. But if you don't want to do it, we don't have to.
Yeah. Let's just leave it.
Right.
Learning for next time.
Yep.
For Monday, though, well, we probably won't do that by Zoom. I don't know.
Or we'll pay for it.
Yeah.
Probably $10. Yeah.
Yeah. That would work too. So
I'm going to set a timer for 40 minutes.
Yeah. Alexa, set a timer.
Right.
So Brian, oh no, my Alexa's actually talking to me.
I heard it. Yeah.
Never mind. So anyway, I was going to ask you, Brian, you were skating around the idea of what is a fiduciary, right?
Yes. Fiduciary duty.
Fiduciary duty. And so I'll take a layman's shot at this and you can correct me. But in layman terms, if someone is a fiduciary, they actually are required to manage your money in your best interest. Yes. And it would surprise you to know that almost all investment vehicles of all kinds are not fiduciaries, which means specifically they're allowed to manage your money in their best interest, even if they know it's not in your interest. They're actually legally allowed to take your money and invest it in a way that gets them paid as much as possible, as long as they can make you feel good that you're still getting some and stick with them. That's you. And this is his whole point about a story. If they can spin you a good enough story that you feel like, oh, I'm getting a good deal, they actually are legally allowed to pocket all they can. And at least I have a good friend who just rages about this. So
yeah, that's exactly right, Ethan. And there were rules proposed to force fiduciary duty on brokers, and it didn't go through. So
what a surprise, died. Right? Yeah, it was heavily resisted.
Unsurprisingly, exactly. So typical brokers do not need to market securities to you, like stocks, like bonds, that are in your interest. So there are some folks that do have to operate in your interest. If you have a pension fund, for example, there are strong rules on their fiduciary duty to you.
Got it.
Outside of special contexts like that, it's really a caveat emptor system.
Yeah. So I don't know, Devin, if you want to jump in on that, but I'll just say in passing, like I was lucky enough to find someone who runs as an investment manager and actually commits to be a fiduciary in writing, which is just unheard of. Basically,
I just want to. I know this is not getting across to most people so far. We're too technical. We're too high level. Yeah, like what they are saying, chat, is that there are people who will come to you and tell you that they are going to manage your money, and then they have no obligation to actually do it. So they are just purely interested in taking your money and making more money from your money, and then not helping you, right? So there is a term called a fiduciary, which is a person who is legally required to actually help you with your money. But even those people sometimes have another identity that they can put on, a mask they can put on, and you don't know which one they're doing which. So you have to be super, super careful. And this is why Brian's general advice is to just screw all of this and go with a larger investment firm like Charles Schwab, like Vanguard, like whatever, and invest in something that follows the markets. Because if you try to get into this mess, it is going to be very difficult to sort of parse through who has your best interest in mind.
Well said.
I've had to get really good at communicating with Twitch. It's another language. It really is. It's like,
it's Devin's usual skepticism.
Yeah,
that you guys can follow anything advanced.
It's hard. It's like, I mean, you can't. No, dude. It's just like, it's true though. If you don't, and this is something I really want to talk about on this show, because I am a pretty big advocate that if you are not an investor, if you don't have like 80 PhDs and freaking 6 consoles like Brian, and like you have like a freaking like his trading desk is like 8,000 screens like Batman, and he's fucking looking at like stuff in the future with like high frequency trading and shit. If you don't have that stuff, then like you have to really think first, is investing in the markets and investing in stocks even a thing that I want to do? Because if it's not your core competency, if it's not a thing that you are spending a lot of time on, right? I know a guy back in Lake Tahoe where I used to live. He gets up at 6 a.m. every morning, sits in Starbucks on his laptop, and he watches the markets from 1 p.m. till 1 p.m. The markets close on the West Coast.
West Coast, yeah.
Yeah.
Not my idea of a fun way to spend a day, but go ahead.
No.
So for that guy, though, or for a dude like Brian, like you want to invest in, like, should Brian have a portfolio in addition to his job at Twitch? Yeah, probably. He's pretty confident in it. But like for someone like me, where my main job is to be here and do funny dances to make people lol W enough to donate to me, right? Like, then like, for me, is it smart for me to actually put my money into stocks? Maybe not.
Wait.
Yeah.
Let's separate 2 points there.
Yeah. Let's
so
go.
First point. Totally right. If you walk into one of these high frequency trading firms, which someone mentioned Robinhood and Ethan's chat, there's some activity there with high frequency firms that might not be above board. If you look at high frequency firms, if you look at hedge funds, these are hyper sophisticated operations. You're not going to win if you go head to head against them. So when you choose individual stocks to buy or sell, you are the chump. The other party knows better than you do most of the time.
Well said.
And that's why these large institutions do something called paying for order flow. They want to see how people like you, like me, how we trade, because they assume that we know nothing. So that gives a signal on how everyone else understands the market. And it turns out that they can use that to their advantage, understanding that I'm dumb when it comes to trading. Don't pay attention to me as a trader. But the second point about investing in stocks all up, there I disagree with you a bit.
Okay. Yeah.
It makes a ton of sense to invest in stocks all up.
I think Devin agrees with that.
Okay.
When you say invest in stocks all up, what does that mean?
I mean, having a broad-based, diversified index in which you invest a significant portion of your wealth for a long period of time.
Yes. What I'm saying is, if I go in and I try to pick, so let's say that I make $50K a year.
Yep.
Okay. And my expenses are $40K a year. And so I have 10,000 left over. And my job is to be a professional clown on the internet. All right. Okay. Is it?
I mean, saying maybe if that were your job.
Yeah. Okay. if it is it the best choice for me to go in and try to pick individual stocks to try to win at, right?
Yeah,
With that
absolutely not.
extra 10K. Right. Okay. And
Absolutely not.
that's what I'm trying to clear up here is so what Brian is saying is you want to have what he says by a diversified portfolio is he's taking a bet on the markets themselves and
Yes.
the broad spectrum of companies in the markets. Right?
Yeah, that's right.
Yeah. Okay. So that's a big difference from what some of you guys might think because you're reading our Wall Street bets or whatever, and you're saying, okay, if I put all my money down on Tesla, I'm going to make a shitload of money. Right? Like,
I am curious
for sure.
Because that's unironically what a lot of people think. Yeah.
Is there any place where you would say someone can invest in individual stocks successfully as a loan, like as a regular human, or is your prohibition absolute? For example,
good question.
Do people who know a specific industry, whatever, I'm a farmer, I work in a textile factory, like can there be, anyway, I'll let you answer the question, or are all individual stock investments folly for the individual person?
For most people, it will be folly.
Okay.
For virtually everyone in this stream, it will be folly. There are some instances in which your so-called private information, some of the secrets that you know, give you an edge. Now, many of those secrets you're not allowed to trade on.
Sure.
So, Ethan, we get the same emails, and this is common. You're not allowed to trade in your own company's news.
Correct.
At least if you're a senior enough officer, you can't do that.
Right.
So it tries to protect other market participants from so-called insiders, folks who know the intimate details of the firm and have this super special information that they could make a really good return on for an individual stock. Setting aside those special cases, it is exceedingly rare to legally have access to that sort of private information that will make you a killing as an individual investor.
Okay.
Excellent. Yeah. Can we talk about when you say diversified portfolio? I think one very productive thing to do would be to break that down by percentage, because some people want to have fun with some of their money, and there's probably a percentage that they could put safely into stocks. That while they have the rest or the wide majority of their portfolio, and when I say portfolio, what I'm saying is your total investment money that you have, right? Do you believe that that should be broken down? So maybe there's like 20% in this, 5% in this. Have you thought about like how that should look for an average investor?
Yeah, so let's zoom out just one step because we need to think about what a portfolio actually means. Devin, You're a young guy. You have a lot of talents. You're making some money now. You have human capital. You've got wealth in your skills. And that matters. So I have a finance background. Ethan obviously has a long career at Amazon before. We have skills at our jobs, which are going to generate us income in the future that we can count on. Maybe not this job, but we'll have another job. We're not going to be permanently on the street. So you can think of that a lot like a bond. So this is something that is pretty safe. And for folks like us, for folks with a college degree, I'd say more generally, that matters. That's a big fraction of their wealth.
So their future earning potential, basically.
Their future earning potential.
Okay.
Yeah, so that's part of your wealth. I'd add, if you have a house, that's a big part of your wealth too. So that's not something that's traded in the financial market so much, but a lot of people, especially in cities like San Francisco and Seattle, have a ton of their wealth locked up in their house. In some cases, more than 100%. So when you think about what is a portfolio of all your wealth, you've got to think of your human capital, your labor income, your house. And then, you can think about the financial assets that are sexy and things like Tesla as individual examples of that. So back to your question, Devin, is there a place for investing in individual stocks or having a little bit of fun? Sure, absolutely. I go to Vegas once a year and, people gamble, but understand this is a gamble. This is not an investment to make money on reliably. And you can make that gamble if you have these other sources of income, these other sources of wealth. that are generating returns for you. If you don't have those, if you're still in school now, or if you don't have a steady job, or if you have a job that maybe is being phased out for whatever reason, then probably you can't afford to gamble in that way.
Very cool.
Wow. So job being phased out. So in this case, you're referring to like I drive for Uber and this job probably is going away for automated cars someday. Is that what you mean by phased out?
Yeah, that's one example. Or my wife is from West Virginia. So there are plenty of folks that don't have jobs in coal.
Yeah. So yeah, that would be, we're probably, talking retirement strategies. I'm probably among the older viewers of the entire stream. Talking retirement strategies probably not most useful. Devin, how would you feel about pausing the high finance for a minute to talk about like consumer debt and getting to where you have money to invest? Is that cool?
Yeah, I do think it's responsible to talk about. So let's just go by the stats, right? The vast majority of Americans and people, I think, and is this true outside of America? Actually, I don't know that. Are people in Europe like in debt up their eyeballs too, or is that just an American thing?
America is particularly good at it.
Okay, yeah, good at being. So we're the best of the worst. Once again, we did it. Okay,
and we're the best. We're number one. God, that's terrible, but it's true.
At least some huge percentage of Americans are going to be operating with student loans, and they're going to be operating with
car payments, house payments,
credit card debt. My understanding is that, and there's going to be a lot of people that are asking, should I have X, Y, Z in credit card debt? Should I invest? And so what's
and so the specific question somebody was asking me over here, I'll just frame it, and you can is. At what point should you increase investing when paying off debt? Is it wiser to pay off all debt first, or is there some ratio, basically?
That's a great question. And Devin, to add to your prompt, there are plenty of rich people that are living hand to mouth too.
Yeah,
it's a common thing. We just consume all that we're paid.
Yeah.
So in terms of debt and debt management, if you look at APRs on credit cards or auto loans, they can be a lot higher than what you expect to earn in financial markets. And for student loans, you have a mandate to pay that first. And some student loan debt will follow you after you're dead. So you cannot escape some of those debts, and it's just better to pay them off. If there's something that's charging you 20% per year, you better bet it makes sense to pay that off, because that is 20% for sure that you're losing. Rather than in, say, the stock market, maybe it's 10% on average, but that's a risky thing. And if the stock market doesn't have a good year, then you've lost your stock wealth, and you still have that 20% that you're paying back on credit cards. So absolutely pay off your high interest debt first. There's an easy prioritization there in terms of stack rank what your most costly debts are. And you have to sometimes be careful about that, because it's not going to be advertised straight up. It's like with payday loans.
Yeah.
That's not going to be easy to spot how outrageous some of those interest rates are. But go ahead.
How would the average consumer be able to identify their percentage interest rates on their debt?
They're given. So if you look at you look at your credit cards company's website, and it will tell you how much they charge on your debt at the credit card company. So for me, I think last I checked, it was like 18.75.
18.75%, like nearly 20%,
which is insanely high. If you're trying to get a return, and particularly one thing to mention is the more advanced credit cards that you get. So my credit card with I got this. Oh, I probably shouldn't show this on stream. Wait, I can't show it on stream. Because I use my real name on Twitch, Smile. So this card right here is the Sapphire Reserve card.
Love that card.
This card is super badass. It gets me a bunch of options. It's really cool. But what it also does is have a 26% interest rate, because they're expecting me, because I have very high credit, and they're expecting me to pay this off instantaneously. So if I don't, and I actually get into debt with this card, I'm gonna get hosed, right? So all those credit cards you get in the mail. Yeah, that are like, hey, we can get you in for free, and you get $10,000 credit line, $20,000 credit line. They are planning they probably have a very high interest rate. So it is your due diligence as a person to know the interest rates of every single debt that you have. And if you can't pay those off, you better make a very careful decision.
So I don't remember which financial advisor it is, but there's this concept called a debt snowball. And basically, the idea is if you do have a bunch of debts and you start making some money, what you really want to do is you want to pay off the highest interest rate first. And so you may have to make minimum payments on a bunch of stuff. You do that so you don't get penalties. And then after you make the minimum payments, you take every penny you have left and you put it on the highest interest debt next.
Yes.
And you try and drive that one to zero. So like a lot of people in debt, they spread the money around and they pay a few. People are saying it's Dave Ramsey, which it might be. I don't know who. That sounds vaguely familiar. But basically, you lean into paying off the highest interest debt. And then as soon as that's done, you take all the money you were paying on that, plus the minimum payment on the next highest debt, and you just keep stacking them together. And the point, they call this a debt snowball because it goes really slowly at first. But as you start paying things off, you're able to take what you were paying on the one debt to the next debt to the next debt and pile them up. And it's like a snowball rolling downhill. It rolls faster and faster. Now, all of this assumes that somehow you can get to a situation where you're making more than you spend. And
that's right.
And maybe we should talk about best practices around that. But
I'd just like to make a point out over there.
Please.
Sometimes you're so deep in debt you can't get out, and I haven't been in that situation myself, and that's of course a tough place to be. There are debt consolidators that can put together your debt in a reasonable package that makes it a little bit easier to climb out of. Bankruptcy in the U.S. is relatively low cost compared to other countries. Obviously, it hurts plenty, but there are other options rather than probably the worst case is taking on more and more debt to pay off your old debts, because then you get into a place that you cannot escape, especially when you have very high interest rate lenders.
This is particularly relevant to me as when I start playing Path of Exile next week. I am going to have to explore bankruptcy options very shortly when I stop working entirely, and I have to explore those options. So that's very good advice for me. Yeah. Thank you.
Yeah, and like I don't think any of the three of us are the best experts on the other side of like driving down personal expenses. Each of us would have different opinions on it. Like I drive really old cars. I've told the story on stream.
I don't drive a car.
Yeah, Devin doesn't have a car at all. I drive a 2006 Jeep with 180,000 miles. How you spend money.
He's conveniently leaving out his other car, but yeah.
No. Like I'll be transparent about it. I also have a used Porsche Boxster that I bought used. But the Boxster costs like 10 grand.
Yeah.
Because I bought it like I don't know, it's a 2005, I think. So it's 15 years old. So I do have a play car. But even still, no, and people are saying the VP has a Bugatti because of this story I've told on stream. Devin's probably heard it. I'll tell it just because others haven't heard it. Someone in my office a few weeks ago saw me going to the garage and wanted to follow me downstairs.
Was I with you?
Yeah, you were with me. Devin was there.
I was with you. Yeah,
and one of my employees came up. Devin was in the office. We were actually going to go do a stream. And he said, I want to know what kind of car the VP drives. And he followed us kind of slightly, disturbing, awkwardly. Yeah. He followed us out. And I'm like, I have a Jeep. You're not going to be that impressed. So we get to the Jeep and he's like, oh, you really have a Jeep? And so I felt bad for him. So I said, well, it's raining today and I didn't want to get the Bugatti wet. And his eyes lit up. He's like, oh, you have a Bugatti. And I'm like, no, because not at all. But the point is, like, I don't know if either of you feel you have a consistent set of advice. You have to decide what you're going to spend your money on. For me, it's not actually cars, it's experiences. So I spend money on travel. And that's where most of my discretionary money goes.
The best advice I've ever heard on this is from a dude named Ramit Sethi. And he has a book called I Will Teach You to Be Rich. And the principal advice here is super easy to summarize, which is that most people think that if you want to get rich, you are going to have to like cut expenses across the board and live like super frugally on like 2 grains of rice. And then you're gonna have to like do everything. And what Ramit says is you should that actually the process of becoming very wealthy is a process in introspection. And I can't wait for Brian to impact this because and what I mean by that is you should find the 1 or 2 things in your life that you are super passionate about and then spend money on those things, then cut out everything else that you don't really care about. So for me, my friends, I love good ass food. I love eating good food that is like healthy, big salads, like organic. The goat was pet and like specifically taken care of, and like they did a ceremony for him before I eat it, like that kind of stuff, right? That's my jam. But I cut out everything else, dude. I don't have a car. I have a very chill apartment, even for Seattle standards. That's like Ethan's been in it.
Yeah, I've been there. I've been there a bunch of times.
It's not impressive. It's like it's not that crazy. It's over a loud street next to a bar. Like it's whatever. And
it's pretty small. Like what is that for square feet?
750 square feet.
Yeah. It's. I mean, he and his girlfriend are there. It's pretty. It's when you subtract the space for their gaming rigs. It's quite compact.
But that's the point. Is that I don't buy big TVs or huge electronics or travel or things like that because I am a closet troglodyte that loves playing games for weeks at a time and disappearing from the face of the earth until Ethan drags me by my feet out to events.
Yeah, and that's correct.
Yeah.
I am actually Devin's like outdoor inspiration. He would never leave the Nerd Fusion office / his place and be happy doing it.
Yeah. And Ethan in particular, like Ethan has his own kind of thing where he loves doing like travel but he saves on way more things. So I think, leading into Brian here, because I've been talking long enough, but like, look, I think that having a specific idea of what you're truly passionate about, spending money there, and then because there's probably like 90% of the shit that you're spending money on. And I also want to just start real quick. There's another point here that's like a lot of you, I think, if you're not doing it yet, when you get into the working world, you're going to start spending money on impressing or having some other kind of thing where you need to keep up with the Joneses, is what they say, right? Where it's like, I got to buy a good car because I'm trying to impress this person, because I'm trying to get a chick, I'm trying to get a girlfriend or whatever. And you got to get your shit out of this too. Get back into your heart and your soul and put money, and don't be afraid to spend on things that truly, truly make you happy. Cut out everything else. Sorry.
I
Brian,
did this. I want to.
Fuck.
Sorry, Brian. This is what happens when Devin and I get going.
Yeah,
I did this though early in my career. Like I bought a bigger house, and I ended up with a 3,500 square foot house, and it was the most useless thing I ever bought because I didn't know. Like it was just me and my wife, and we had to furnish these rooms. We never went in because they were like extraneous rooms. Mm-hmm. Now, luckily, like this is where luck turns out. Like I was in Washington D.C. and the thing went up in value. So when I realized I didn't want it and got rid of it, I ended up with more than I started with. But what a terrible waste. So, all right, Brian, you're up, man. Tell us the low end of finance.
Look, guys, I think you nailed something here, Devin. That introspection is your most powerful asset. And it's your most powerful asset both in how you invest and in how you consume. So in how you invest, there's things that are common for everyone. So Sharpe ratio is one example. That's average return over volatility. So it's a measure of reward to risk. That everyone should think about. But when you invest, you should be thinking about what risks am I comfortable with? Not avoid all risks, but what risks am I okay taking? What are the bets that make sense to me that I'm willing to take a chance on so-called growth stocks or value stocks? So stocks that look like Google versus stocks that look like Ford. So thinking about what risks you're comfortable with is really powerful. And on the other side, about what you consume, you need to think about the same reward per unit dollar ratio, not so much risk, but what gives you per dollar the most joy? And now I'm sounding like Marie Kondo here, but
Does
don't
not spark
burn
joy.
Yeah, exactly. Don't burn money on stuff that doesn't spark joy. Don't have that dining room that you use to impress people twice a year that takes 150 square feet times however much you spend per square foot.
Yep.
Like you're furnishing that thing with all this fancy stuff. Go to a restaurant when those people come by. Take them to a nice restaurant. It's a lot cheaper. So if that doesn't do it for you, you're just burning money. So figure out the cost-effective ways for you of finding joy, fulfillment, etc. And that's going to streamline your budget very strongly. So you can do that same sort of stack rank. Like, what are the things that have the highest reward per dollar? And then cut out the ones below some threshold. So for you, you don't need a nice car. I don't need a nice car either. That saves us money.
Yeah. Like, dude, I probably spent $450, $500 on Path of Exile. I've got 1,800 hours in that bitch. Do the math, right? It's less than $1 an hour, dude. Right? That money has made me so happy. I can't even tell you, right? EVE Online, same thing. I bought a ton of stuff on EVE Online. Super happy because dollar per value, right? Like a lot of us are gamers, and man,
finance is a game for sure.
Yeah, but not only that, but like also like if you're a gamer, one of the best values for your money can be games, because like a game maxes out at $60, and if it's not like the Call of Duty campaign, it's going to go really long, right? And there are plenty of games that I've gotten hundreds of hours off of, hundreds of hours of value, right? Like
for sure.
But thinking about life in that way, when you look at it and you actually think like, if I buy some IMAX movie tickets and it's $40 for two people and it's 2 hours, it's actually pretty expensive. That's $20 per hour that I'm spending, right, on entertainment. Versus if I buy one computer game for $60 and I play it for 1,000 hours, or like more realistic, like 200 hours, right? The ratio is a lot better. And so what I'm trying to use in this analogy is how to think about things in that way.
That's right. And that you can apply pretty much everywhere. And there's a risk of sucking joy out of life by having too much of a computation mindset. Like, oh, what's that thing worth to me? And am I willing to spend on this, but not that? But having some simple rules for yourself of, am I willing to upgrade to first class if it's this much versus that much? Or am I willing to spend on a nice meal versus a not nice meal? Having some simple things kind of pre-computed.
Can you talk about some of the rules that you think people should, like the kind of critical questions people should ask along those lines?
Yeah, sure. So I'd say there are some basic habits that most people have, like be it getting a cup of coffee versus making it. Do you need that experience in the morning? That'll cost you an additional $3 per cup of coffee. If it's worth to you, great, do it. Go to your Starbucks, do what you need to do. Thinking about how you commute. So in the Bay Area, you have a choice. If you're, say, going from South Bay to downtown, you have a choice between spending 2 hours in your car or 2 hours in BART, or connecting Caltrain, BART, what have you. You need to decide how much it's worth it to you to be in the comfort of your private vehicle rather than on a set of trains. And that's providing you a lower bound on how much you should be willing to pay for a car. So I'd say that those are some of them. Rent versus own.
Time. Your earlier one was time versus money, right? Can you spend time to save money, or can you spend money to save time? Because you can usually, at some ratio in different circumstances, they can be traded off. Commute is one. Fixing your toilet or painting your house is one. Like, hiring a painter is expensive, but like taping all your walls and stuff, if you need to paint something, for some people is maddeningly insane.
Yeah.
And it's legendary what a bad idea it is to be your own plumber, but then some people try it. So anyway, go ahead, please.
Yeah, that's right. Thinking about the value of your time is incredibly important. So if you're paid, say, 50 grand per year and have 2,000 hours per year, that gives you a conversion rate that says, oh, I'm getting paid $25 an hour. So I should, in general, if there's a task that takes me an hour that I don't like, that costs less than $25, I will outsource that task. If it's a task that costs me $50, now I need to think about it. Is this something that I really hate and willing to pay the extra 25? Or is it something I'm okay accepting?
That's right.
That's
So
super good.
a couple questions that have come up that I've seen go by. We haven't really talked about real estate. Looks like Devin's gonna bail, and maybe so we can talk about this real quick.
Sure.
We haven't talked about real estate as an investment. Any opinions, thoughts? You talked about buy versus own.
Yeah. So probably the most relevant is the buy versus own decision.
Or buy versus rent, sorry.
Buy versus rent. And that's there are all sorts of rules of thumb. So I'll give you one. You can think of price to rent ratios. That's a measure of how cheap it is to own versus rent. And what you find is that price to rent ratios are low in areas that typically have lower opportunity. So, for example, I just came from North Carolina. So I came from Durham, and it is a lot cheaper to get house there. And rent is actually pretty high, at least for relatively high-end housing stock. So the price rent ratios are pretty low. In that case, it's a good decision to buy a house relative to San Francisco, where prices, you're talking about millions of dollars. You see things on the news from time to time, millions of dollars for a shack. Now, that's an extreme example, but you can use price rent ratios as a guide of how expensive is it to have the privilege of home ownership rather than renting something out. Now, folks often think, well, rent is a bad call because I'm not actually getting equity in my house. I'm not getting some fraction of ownership by paying the rent. Well, that's true. You're not getting some of this ownership. You're not investing in this house as an asset, but you're also not paying the property tax and the upkeep. You're not taking on the risk that the housing market in your area craters. So it's a risk and return story of, yes, you are accumulating equity when you're paying down a mortgage. But at the same time, you have a massive fraction of your wealth tied to a house. And in some markets, that's really a mistake.
It's
go ahead.
Well, this is one place where I've always been confused on the right actual advice.
I actually have too.
Because, for example, I have a friend, he's my producer, Devin's met him as well. He borrowed a ton of money to get a house. It happens, okay, good luck is always awesome, that he bought a house when the Seattle housing market was down. He bought like all the house he could, and it's made him more money than his job by far over the last few years. Now, he does have the problem that a lot of his money is then tied up in that house. Mm-hmm. But like, this is a first class problem, right? Like lots of money tied up in his house.
Yeah. Poor guy.
Yeah, exactly. Like cry all the way to, the home equity loan or whatever.
Yeah.
But I often rented. I own right now, but I rented because I hate maintenance and I hate I grew up on a farm where I had to fix everything myself. And, it was always paint this, scrape that, mow this. And I'm like, I never want to mow ever again in my life, So that's your like, how much would I pay to get out of this? So I like to rent. Can you somehow, Devin's saying he's confused too. Is there a way to simplify this? Because you talked about like price to rent ratio or something, which I admit, even for me, like, you missed me.
Okay. So let's talk about this ratio for a second, because it's worth thinking about, because it applies everywhere. So you look at stocks. So what's a stock? Well, a stock is a claim to a stream of future dividends paid by a company. So Amazon, you're paying dividends. Walmart, you're paying dividends. Now, in addition to those dividends, you also have the price of that claim. So if I bought Walmart, I could sell it back for the price of Walmart. So when I think about what a stock could potentially do for me in terms of increasing my wealth, either dividends go up or prices go up. There are really two simple sources of gains
in a stock
for stocks.
Okay. The share itself goes up from $10 to 12.
Yeah.
Or it pays me dividends, and maybe those dividends get higher.
Yes.
Got it.
So there's a commonly used ratio called price dividend ratios.
Okay.
So what's a price dividend ratio? It's saying how much do you have to pay to get access to that future stream of dividends?
So I pay $10 and I'm going to get some dividend that's averaged $1. And I have this belief that if it goes on for 10 years, I get my $10 back in a way, although that's bad logic, but okay.
It's not bad logic. It's roughly right. You have to worry about discounts. You need to worry about risk, but yeah, roughly right. So the easiest way of saying whether a stock is expensive or cheap is for the same stream of dividends, is the price high or is it low?
Okay.
So if you have a stock that's paying you $1 every 6 months and it costs you $10 versus another stock that pays you $1 every 6 months and costs you $20, well, it looks like the one that's $10 for the price of admission
It's twice as good.
It's twice as good. It's cheaper. So when you hear on TV, this stock looks cheap or this stock looks undervalued, they're often looking at this price dividend ratio. They're looking at what is the cost of admission to getting that stream of dividends. Now, it turns out it's the same for.
All right. I'm assuming that we didn't reset the Zoom call and it's been 45 minutes again. So we'll be right back. The issue here is we didn't before the stream set up free Zoom, or free Zoom kills us every 45 minutes. Devin was ready, so we'll be right back in because he's smart. So 1 second, I'm bringing it back. Bueller. We'll fix this for the future.
It turns out it's the same thing for houses.
Oh, that's
so
fast.
For houses, you've got the price of a house, and what do you get for the house? Well, you get to live in the thing. You get the joy of having a house. Now, what is the value of that joy? What's the value of that the market's willing to pay? The rent. So the dividends for a house are your rent. So when you call housing expensive or call it cheap, you're thinking of price rent ratios, just in the same way as stocks. There are price dividend ratios.
Got it.
So there's a universal kind of rule for evaluating whether something's cheap or expensive, be it for houses, be it for stocks, any sort of asset. Now, it's not a free lunch, but it's a good mental model to have. So that would be my first. If there were a single statistic to look at price rent ratios. Now, it turns out there are calculators online that make this sort of calculation easy. So Fidelity, for example, you can plug in all sorts of attributes about houses and expected transaction costs, how long you're going to stay in a house, expected growth rate of houses, house prices in your area. You can put in all that stuff and it will spit out an answer. And for houses, it's worth using a calculator to figure it out. It's one of the biggest decisions in your life.
Totally.
Are you going to buy?
Isn't it like, I mean, basically, while this stream's demographics may be different, the typical American family spends 25 to 35% of all their resources on housing. That's roughly right?
Yeah, it varies across city, but yeah.
So it's right. Like a third of the average person's money is housing.
That's insane. It's such a huge difference.
And that, so it's bar none for the average American anyway, and probably worldwide, like at least in the developed world, it's the biggest single expense category. And so if you're willing to live further away or cheaper, or it's also the biggest single place where you have control, right? Because when you're like, people in chat were talking about, the cost of a $5 latte every day, which is true. But if you really want to change your expenses, you look at your rent or your mortgage, how much house and where. Because if you want, I have friends, they've bought really big houses. I have other friends who haven't. You have Devin who hasn't. How much you can put in your house, particularly and then Brian's down in San Francisco. I'll just say there's another guy at Twitch. He was looking at a San Francisco house that was $4 million, right? And like contemplating, trying to buy a $4 million, and it wasn't, because it's San Francisco and it's now the most expensive market on earth, practically, if not. That isn't like you'd think like $4 million house. Oh my God, it wasn't.
Yeah.
So.
Yeah, that's right. So basic advice, just life advice and financial advice. The cost of getting a decision wrong should be your guide for how much time you spend thinking about it. So for a house, you can use the basic rule like price rent ratios, but don't. It's worth figuring that out because this is one of the largest investments you have, especially in a place like San Francisco. Think less about that Starbucks decision because this probably is not a large fraction of your wealth. Think a lot about whether to go to college because that changes your entire lifetime stream of income. So human capital is a large fraction of most people's wealth. So that's a decision to think about really carefully when dropping out of college to pursue your streaming career, for example. But you have a limited amount of mental time and energy. Spend it on the things that matter.
This is like Dr. K talks finances. It's fantastic. Personal happiness crossed with finance. Well, it's true, right? Money can't buy happiness, but lack of money seems to be able to buy unhappiness really quickly, right? Like
for sure.
People with financial stress, they don't live as long, all kinds of stuff. So, all right. So, I have a question here that I just want you to explain to me. Someone keeps asking, Michael Burry dislikes index funds. I don't know who this guy is. Is this somebody you know, Brian? Do you know what they're talking about?
No, news to me.
All right.
Ethan, this is bait.
Yeah, all right.
Yeah.
It's bait. All right. I've been baited. Never mind. Moving on.
All right.
You're getting baited. Yeah. Yeah. 100%. You can still, it's some idiot in chat that's like, well, this guy said that this wasn't good. What do you think about that? Like, never pay attention to that.
Don't go there.
Yeah. It's
I
super
defer
dumb.
to the more senior streamer amidst us.
Yeah,
who
I'm
says,
the professional
sorry.
clown. I can tell you. Yeah.
When you have folks on TV who are giving you financial advice, the reason why there are so many channels that do the same thing is because everyone wants to find the advice that reaffirms what they're already thinking, not necessarily some sound advice. So if you're the one guy who thinks that index funds are a bad call, you will find that other guy who's paid to do this on TV who's going to tell you you're exactly right.
Yeah. Mm-hmm. So that's a really good conversation we could open up with, like, Brian, who do you trust in this world? Like, given that there are so many people wanting to tell you what to do with your money. And by the way, the more money you make, the more true this is. One of the craziest things that ever happened to me was when I sold a company, the amount of emails, all of a sudden I was the coolest person in the world. JP Morgan, freaking Fidelity, every company ever was like, hey, what's up? Wow. We were just passing through and like, we heard you like sold a company that's really interesting. Have you ever thought about what you're going to do with all your money? Do you want to give it to all of us so that we can have it all? Do you want to do that? Can I get on a call with you in 5 minutes? Do you have 5 minutes? And I'm like, holy shit, this is actually insane, right? Like it was really, and so there's so many people that will come at you telling you good financial planning advice. So what resources can you utilize to educate yourself on this, which is one of the most important things you can do in modern society?
Yeah, good point. So first off, Vanguard has effectively zero marketing budget. Why? Because the product sells itself. Now, there are some rare instances in which that's true. There's just something that is so well known and so cheap for access to the product that you don't need someone to spin a story. And those are often good things to invest in. So I trust Vanguard. That's where I invest for me. This is not direct financial advice to invest in Vanguard, but that's what I do. Who do I trust beyond that? I think there are some good blogs out there. So one that I pay attention to for understanding markets better is The Grumpy Economist. So this is John Cochran has a blog. He's at Stanford, Hoover Institution. He was at U of Chicago for a while. He has pretty good insights on how markets work and what sorts of things should concern you and what sorts of things shouldn't. So, for example, he has a recent post on coronavirus. It's a great read, and I highly recommend reading it. Go ahead.
I was going to just throw in one. I don't know how you feel about this, but I am actually, and I'm going to get memed maybe. I am a very big fan of Tony Robbins' 2 books on this, which never ever get brought up. One is called Unshakable, and one is called Financial Freedom. Let me give you an idea of how Money Master the Game is the book. So this is the book right here, and I know this is like a very unexpected thing to be like, wait, why is Devin bringing this up? Because this is like a really weird thing that I've never talked about. This is the book right here. It's a very big book. It's like 500 fucking pages. So what Tony Robbins did was he sought out to go. Tony Robbins for people that don't know, is a massive like self-help guru. Some have said he's like a crazy dude that's like, but I am a big Tony Robbins fan. But with this in particular is very interesting because he set out on a specific mission to try to fix this problem for people. And he doesn't sell a course about this specifically. He went to key investors all over the world, including hedge fund managers like Ray Dalio. There's a bunch of people that got into this. And I don't know if it's like on here, but he found like all these people, Carl Icahn, Warren Buffett, and did personal interviews with them to try to sort of like figure out how a normal person could like go and figure out all this difficulty around finances. It talks about a lot of what we talked about here, fiduciaries versus financial advisors, ETFs and things like that. And it tries to give a simple plan. For the $14 that this Kindle book is, I have read this book all the way through. It provides an enormous amount of value. And he has no financial interest in this because he donated the proceeds even of the book itself. To all of the money off this book itself is to some financial, I think it's to his charity he does where he like gives people turkeys for Thanksgiving, whatever that is, the Basket America campaign or whatever.
What I would say about this, Devin, is everyone should read some. You can pick the books, but getting educated on at least the basics of money and investing.
Yeah.
Whether you read Tony Robbins, who I think is great, there's all kinds of others you can read. You can read Beating the Street. There's so many, again, I'm not saying any of these books you should then go take your life savings and exactly follow them, but having some idea how the financial markets work and the different types of investments. Because, for example, we haven't talked at all here about bonds. And I have actually very strong opinions, which Brian might disagree with, or he might be like, yeah, fucking A, so we'll find out. We also haven't talked about, people in my chat are asking about timing the market. So, for example, there are those people who believe that, coronavirus is going to push us over into some global recession. Should I act on that belief or not? So I'll just generalize it and back away from that. Brian, if you don't mind, Devin, Brian, do you have anything to say about timing the market?
I have a lot to say about timing the market.
Explain the term first.
Yeah. So what's timing the market? Timing the market is the idea that you can identify market peaks and valleys, and you can buy low and sell high.
That sounds great.
That's simple.
How do I do that?
Yeah. How do I do it? Well, if I knew, I probably wouldn't be here. I'd be on a beach somewhere, Ethan. Look, so there are all sorts of magic formulas that people offer to make you healthy and wealthy and wise. And unfortunately, most of the time they're bunk. And that's absolutely true with most market timing strategies. So the most typical class of market timing strategies are so-called technical strategies. Yeah, I see Stale 2000 in the chat. Oh, just draw a magic trend line or cup or shoulders or whatever feature that you see.
It took me a long time. The cup with the broken handle, like these technical traders. I won't distract from it, but like there are so many theories. There's so much snake oil here You are
Yes.
much better going to like a random herbalist healer who compounds stuff and says it will make you 7 feet tall and give you wings.
Yes.
Way more likely.
Yes. And, some of these signals will work in the same way that if you try 20 things, one of them seems pretty significant by chance. So if you're thinking about statistics, there's a kind of 5% rule that people often apply. So it turns out with technical strategies, your ups, your downs, your shoulders, your what have you, they do not work. It's that simple. They do not work out of sample. They do not work after the data that you've looked at to calibrate your strategy. So don't do that. If you want more systematic analysis, there's a nice paper from around 2000 by some famous econometricians that look at 10,000 of these strategies. And they conclude, look, their performance is exactly what you'd expect by chance. Some seem to do well, some seem not to do well, and none of them are exceedingly good.
Didn't they have a study they did where this is literally a study they did. I read this. I think I read this in a newsletter. They had a group of financial advisors. They took all of their predictions, and then they had some guys throw some darts at a board.
And the darts did better.
And the darts won. Yeah.
It's not wrong. And there's a nice, I don't want to spew off too much academia, but there's a nice paper in one of our top journals, the Journal of Finance, where it says, look, equal weighted strategy where you just like buy, say there are 10 things, you buy 1/10 of every one. That performs better than most financial advice. Just like
shit, that's
spreading
crazy.
it over.
Yeah.
So there are systematic studies of this.
So one of my friends definitely rails against the talking heads on TV, right? Because like whether it's Cavuto on Business or whoever you like or dislike, remember they're there to entertain and make news. Like
That's
they're in the entertainment business, not in the financial advice business, right? So now there are, global events. I don't know. You can I guess the thing is, people who try to time the market, of course, sometimes they get it right? Like on any given day, that's like the day trading fallacy that sucks people in.
Yes.
Is if I bet tomorrow that IBM will go down, I've got like a 50-50 chance of being right. And so I can get this false reinforcement, whether it's the whole stock market or not.
Yeah, that's exactly right. And oftentimes on these shows, you have talking heads that are brought in and their primary credential is predicted the last recession. That's great. If I predict a recession every year, I can be that guy too. And there's actually
so what you just said is so important, okay? Because this is basically how I build my brand. I just say a bunch of stuff and everyone forgets the shit that I get wrong, and then I really make a big point of the stuff I get right.
Yeah,
Jesus.
that's right.
And
I've never thought of that, Devin, but that is exactly how that works great, because very few people will call you and you can explain away. No, you can explain away. Like, yeah, I said that, but we're moving on. Don't bring up the past. Meanwhile, you're bringing up the past of everything you got right.
Mm-hmm.
Oh.
Yeah.
Oh, yeah.
You have the opportunity to market yourself however you like. So if you're saying a bunch of stuff, you take the clips that look prescient and make you look like the world's smartest dude.
Yep.
And no one's going to be mining your channel looking for the other shit you say.
No, they do, but we just we stuff those people in a box. Yeah, like
they're banned.
What about that one time with FaZe Clan? I'm like, good, shut up. All right, let me talk to you guys about Stadia.
That's right.
It's confirmation bias, right? Like even if Devin wasn't actively hiding his, like cooks have to eat their failures, doctors bury them or whatever.
Right.
Even if he wasn't actively doing that, just confirmation bias. You remember your right calls, and because no one wants to remember the time they totally assed it up.
Yeah, you'll actually screw yourself on this because your mindset will be like, wow, I'm fucking right all the time. I'm fucking awesome. And then you'll lose your ass.
I will tell Brian, years and years and years ago, I bought an individual stock, and it was the first individual stock I had bought in decades. And I thought, I think I know something here. And so years ago, I invested in Netflix. And of course, that's worked out in my favor.
Right.
And so I'm like,
you can do this.
Yeah.
But you can get lured in of like, let me try that again. No, bad idea. I'll be like,
this happened to me with cryptocurrency when I was like, man. So here's what happened. Okay, Brian, I got into Ethereum at $90. So I bought back in at $150, and I was like, I am the greatest. And I was literally like on Coin Market Cap. I had read it up. I was like, yes, I understand the fundamentals. It makes sense. Like, yes, this is a very big value proposition. And I started I got into XLM, and I got into like all these different things, and like my whole chat is like leading me on, and they're like, dude, yeah, like, oh my god, you're so smart. And I'm like the authority on Twitch for this, and everyone's like, should I invest in crypto? I'm like, well, let me tell you, I have the answer. Crypto like goes up, I buy again at 900. And because I'm like, it's going to the moon at this point, and like everything's going up, it goes to 1,500. I hold. It crashes to like $100. I lose everything. And to this day, I have fucking useless Ethereum points sitting in fucking Gemini. And I'm like, I'm literally like the old guy, like I'm the old family member waiting for the person to come home from war. I'm like, someday it will be back. One day it will be back. I'll have my money again. Like, it's just over, dude. Like, oh my God. Like, everybody is actually vulnerable to this. Like, you game yourself, man.
Yeah, you're looking for the second coming of Ethereum. Yeah. Sorry, man. I don't think it's going to happen.
What?
The second coming of Ethereum.
You wait.
It's a new religion.
It'll be right. I'm coming. I'm going to send you a strongly worded letter the day that Ethereum comes back. And the letter will be embossed with gold. It will be written in gold, which is the money that I made when I get my Ethereum money back, Brian.
Dude, I'm waiting for it in 100 years. Looking forward. But you make a good point here, Ethan, talking about individual stocks. I remember growing up, my dad would always have the financial news on. And I'm like, Dad, this is the most boring stuff in the world. Why are you doing this? And he's like, I got to see how my portfolio is doing, Brian. Like, get money on this. So he's talking about like Qualcomm. This is like the 90s. Like, this is a thing. So the stress and angst of watching your stock go up and down day after day and having your well-being tied to some totally random event outside of your control, that takes a toll. And it wastes a ton of time. So if you invest in individual stocks, or if you invest in indices, or if you don't invest at all, some amount of knowledge is good, but watching stocks day to day, reading financial news every day, unless it's your job, is just going to drive you nuts.
That is so true.
And doubly so for anything crypto related. Like, take that times 1,000.
I was like stressing every minute of my life. It was like Ooh. The craziest roller coaster.
So I don't want to open a huge discussion of margin, but when I was young and stupid and I was in my first startup, I had a great early experience, which then taught me some things painfully. I joined a startup and it went public. So it's like the great story, right? You're in a startup that goes public, the stock is going up, and these people around me are like, you know how we can make even more money? The company gave you 100 shares of the stock, but if you do this thing called margining, you can borrow against all of that and buy more, and it'll go up more. And I'm like, this sounds great. And you don't understand that there's this, everybody's giving me like the double forehead in chat, right? They're so right. Like the face palm. Because of course it went down. And there's this thing called a margin call when you borrow money. And the margin call is like your bank calls you up and they're like, so your stock went down. So you have two choices. We're either going to sell all your stock to pay off your debts, or you can wire us money by tomorrow. And I'm like, 3 years out of college or whatever, and I don't have money to wire them. So I don't know, like the real point is getting people get sucked into really dumb things where they think they're going to get rich instantly.
Options are dumb.
Options have their place. Financial instruments have their place, but mostly that place is not in our portfolios.
It's like options, derivatives, all that stuff that we probably don't have time to cover are great tools for financial institutions and full-time traders, but
do you think that options have any place in the investing strategy of a young investor that can take on a lot of risk?
It's hard to see how. Private information is one way that you can use options. So what options let you do?
That, if your private information is Reddit,
no.
Okay. Yeah.
It's very simple.
Listen to him.
Options let you take leverage. Mm-hmm. Options let you, if you have information, let you take advantage of that information cheaply. Options let you, if you have a big risk, they let you hedge that risk in sophisticated ways. Most of us don't have complex risks. Most of us have very vanilla risks. We worry when the aggregate market goes up or down because, well, we have a little bit of money in it, and our employer fires people when the market goes down. You don't need some complex options trading strategy to take advantage of this. And options aren't cheap. There's a large premium, literally a synonym for price in options. There's a large premium for cutting off your risk exposure in sophisticated ways. And they're illiquid assets that are hard to get out of in exactly the bad times. So for most individual people, I would avoid, especially in your 20s, there's probably no need.
Mm-hmm. And so what can a person in their 20s do instead with that same amount of money?
Index funds, man.
Cool. What's your opinion on dollar cost averaging? And you can explain it if you want.
That's a form of market timing.
Is it really?
It's a form of market timing.
No. So let me refer to, if I say dollar cost averaging, say I'm going to put money into the market. Okay. So my definition of dollar cost averaging is, let's say that I make $100 a month.
Yep.
Okay. And I want to save 10% of my savings, and so I put it into at the 15th of every month. It's just a discipline.
Sure.
I thought the dollar cost averaging was wise because the market is down statistically.
You're not timing. Well, I thought it. Yeah. I thought the whole point of dollar cost averaging is if you're investing on a schedule, you're explicitly not timing the market, right? You're like.
So let's disentangle two ideas.
Okay.
One idea is exactly what you're talking about. That's a smart thing to do, to have some sort of disciplined schedule that says, when I get paid, I'm going to carve out some money and invest it rather than spend it.
And rather than try and hold for some other event, I'm just going to put it in on this date.
Exactly. So that's the key distinction. So for dollar cost averaging, there's another world which you're thinking about, I've got $1,000. Every month, I'm going to invest 100 for the next 10 months. So that's different. That's different because what that means is that for your first month, you have 90% of your money just sitting there doing nothing for you. So the idea of that sort of dollar cost averaging is that there's some sort of time diversification.
And you're saying that's market timing and not
I don't understand.
Yeah. So Devin, what you're talking about is carve off a fraction of your paycheck.
Yeah.
That's smart. That's good behavior, good habit.
Yeah.
Dollar cost averaging also describes, I'm sitting on some money and I want to invest in Amazon.
Yeah.
So what's Amazon's stock price?
Sorry, Brian.
Okay.
No one here wants to invest in Amazon for safety. We do not want to talk about that.
Let's talk about Walmart. Okay.
Yes.
So what's Walmart's stock price now?
Some very foolish people want to invest in Walmart. That's a great discussion.
Okay.
Foolish people want to invest in Walmart. That's Walmart's at $115.92. All right. So you've got your $1,000. You could say, I could invest $1,000 in Walmart today and buy something like 8 shares. Or for the next 8 months, I go and buy something like 1 share per month. That is a form of dollar cost averaging. That's smoothing your investment in Walmart with the idea that maybe Walmart is expensive today. And if I wait a little bit, I can get a little bit more for my money next month. So that's a strategy that I would avoid. So that's market timing. That's the idea that if you wait, somehow you're going to be better than investing today.
Yeah. But okay,
what you have in mind? Great.
What would you call what I had in mind? What strategy is that?
Smart saving.
Okay. Yeah. Okay. Yeah. So
sorry, Devin. I got to cover something just because we mentioned Amazon in a way that we probably shouldn't have. Look, since I work for Amazon and since I'm a vice president, I can't talk in any way about Amazon stock, Amazon price, Amazon future, Amazon anything. And so even though Brian, who also works for Amazon through Twitch, was not trying to do that, he was simply using it as an example of a stock. We have to be incredibly clear that we are in no way talking about anything about whether or not Amazon stock would anything, whether it will, we just don't talk about it. So
absolutely.
It's not a topic. We're not recommending anything. We're sharing no knowledge, blah, 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 blah. Imagine as many disclaimers as you can fit. And then as we did, we changed the topic to Walmart, to Ford, to IBM, to,
take your favorite stock.
Pick your favorite stock. So that's what we'll do from now on.
The Grim Reaper of the SEC just quietly fades back into its like.
And I want I want him right there because the last fucking thing I want to do is, And I am sweating. Someone in my chat says I'm sweating. No, it's just not appropriate.
Right. It's also not true that we're literally nobody on this call is representing Amazon and Twitch in any official capacity. We're not talking about any information that they might have. There's nothing like that. None of that has been in this conversation at all.
Yep. Thank you, Devin. Mm-hmm. All right. So back to you, Brian, now that we've covered that.
Yeah. So Devin, what you're talking about, that's just smart saving. So you're talking about, I have a rule where I save 20% of my paycheck, and instead of just sitting in the bank, I invest in the stock market. Totally reasonable.
Okay. Do you think 20% is a good amount?
It depends on your consumption. Like, if you've got a family of 4 and you can't afford to spend 10% every month investing in stocks, that's reasonable. For young folks who are unencumbered, sure, I save something like 40, 50% because I don't spend much.
This is actually a good question. Can you, but you can answer that for Devin. Sorry, go ahead. Answer that for Devin. And then I want to go to the general advice you'd give people.
Yeah. What do I buy? Not too much.
Damn, dude. That's actually crazy.
I spend on rent, I spend on food, and the rest I just sock it away.
Cool.
I do the same thing. Right. And I have So, okay, everybody knows I'm old. They call me a boomer. I'm not, but I'm close enough. But people don't know about me is my parents, I was a bonus baby at the end. My mom famously, when she was pregnant with me, said, "I'm what?" And so my parents were from the Great Depression. And the joke in our house was they could squeeze 2 pennies together and make a nickel. The result is I grew up super conservative financially. And so I've been saving at different rates my whole life. And so I certainly advise that, right? Like a lot of the people here, you're young, but you're going to have careers like Brian and I do, or like Devin. You're going to be an oiler like Devin who makes money entertaining people and dancing.
Implying people actually subscribe to the stream.
Yeah. And so as you have money, save some of it. Because of the miracle of compound interest we talked about when the stream started. But Brian, the question for you is, and this is a really hard one for me, I wrestle with.
Yeah.
How do you know if you're saving quote unquote enough? Because you can always save more. You can always cut out one more latte. You can always skip dinner out and eat ramen noodles. How do you not have that become a psychosis? Is there a way to know it's enough?
Yeah, the way to know it's enough is following that advice from earlier. Your retirement is an important thing. I hope to live well beyond the day I retire. So call it 20 years.
Actually, sorry, I'm going to interrupt you. Don't you hope it's one of the places I think advice is bad is now life expectancy is more like 25, 30, 35 years beyond typical retirement age.
Yeah, and you need to guard against that. There's a risk of living too long. Because you run out of money.
You have lived too long.
I'm going to be streaming on Twitch yelling at nerds when I'm 90, dude.
That's right.
Yeah.
Well, maybe your audience will be here. I hope so, Devin, but maybe not. You have to guard against that.
Oh, baby. That's scary.
Yeah. So how do you know
they might be on Mixer.
Oh,
I'm kidding.
Too soon.
Don't worry, they won't be. They only have 3% market share. Okay, go ahead. Sorry.
Yeah, I don't think I can comment on that after our disclaimer.
No, you can bag on Mixer. We just can't discuss
Just tell
their parent
tell me
company
first,
as an investment. Like,
what is Mixer?
What is Mixer?
Yeah.
Exactly.
Yeah. Sorry.
Nice. No, that was well
Low hanging
played.
fruit. So how do you know whether you're saving enough or too much? You need to think about what your risks are.
Mhm.
So first off, are you saving enough for retirement? There are simple financial planning tools. Like you can go online, you can Google, am I saving enough for retirement? And I assure you, you will see 20 tools that will talk about the right rate for you for that objective.
Tony Robbins also has a free tool through Money Master the Game that you can literally log into, and it plans out by percentage if you're going to, like, if the market, there's like 3 different options. If the markets are like terrible, if the markets are okay, and the markets are great, you can literally plan it out. And this is something you should do. And the earlier you do it, the more money you'll make.
Yeah, this is not rocket science, and there's a little bit of rocket science going in the background, but you don't need to worry about it. Someone else has done that stuff for you. There's stochastic calculus, which traces out all these possible paths of the stock market. You don't need to know it. It's fine. So that'd be the first one. The second sort of risks to think about are having kids. That's expensive. Ethan, you just gave a story about that. If you're planning to have kids, think about college expenses. Think about child rearing expenses. And in places like San Francisco, it's really popular to have folks like nannies and housekeepers. If that's your thing, or private schools are your thing, got a budget for that.
Ethan, send your kids back. Too expensive.
It turns out they're not. They're like no deposit, no return or something. There's no,
Yeah, there's no refund policy.
No refund offered. Warranty, no warranty stated or implied.
But there's no such thing as a cheap kid.
No.
Food, housing, clothing.
Well, and it turns out I can speak because I don't. Brian, do you have children? You do not.
Yeah, no.
Yeah. It turns out, sadly,
I have hundreds of them.
Yeah.
Yeah, it looks like you've got about 700 right now, Devin.
Oh, yeah.
It turns out you get attached to them, and you want the best for them, and that drives up like what you're willing to spend on them. It's actually, truthfully, by the way, from a pure financial perspective, children are the worst idea ever. That's there's plenty of data. If you look at like the total cost of raising a child based on the impact it may have on your career and that it will have on all your expenses, they're like, we were talking about a Bugatti earlier. Go get a Bugatti, much cheaper. Yeah. So anyway, that's an aside. But like, if you look at the total cost of ownership of a child over a 18-year or 24-year arc, like, yikes.
My retirement plan: have a kid, have him be the VP of Amazon, and then have them take care of me when I'm old. Bam. Flawless victory, dude.
To be coarse about it, kids are investments. Kids are also consumption.
Yeah.
So, if you're not getting joy from it, I won't make life recommendations there. That's out of my zone.
Mm-hmm.
But thinking about the sort of risks you're exposed to, right now we're in a time of coronavirus. So it turns out some folks are stuck in hospitals, and they're footing the bill after being forced to stay in the hospital for weeks.
That's crazy. It's true.
That's
but it's
actually
crazy.
Insane. Holy shit.
So you get quarantined or put in,
and then they got to pay for it?
You have to pay for it.
That's some Mexico wall shit, dude. Holy shit.
That's like one of those things. By the way, Devin, have you noticed that Zoom is helpfully counting us down to implosion?
I'm watching it.
Yeah, okay. I'm seeing that.
Do you see how fast I was on the last one?
Yeah, you were there.
Yeah,
it was like
your quick hands, Devin.
Down and up.
I'm ready.
We'll have a better system. So, as an aside, for those who've joined, we're going to do, we have an expert coming in to talk about coronavirus live Monday at 9 a.m. Mm-hmm. Devin and I will co-stream that too. We'll fix our Zoom problems.
Yep.
And
it's $15. I found out.
All right. So we'll have it fixed. But we actually have a professor from Columbia who portrays himself quite reasonably as Earth's virus professor based on his history. And he's going to come on Twitch and do an Ask Me Anything about coronavirus, which Devin and I will host. So 9 a.m. Pacific Standard. Yeah. So that's an aside. It'll be posted. I'm sure Devin will post it in his Discord. I will too. Devin's going to have to get up, so I'll do all the talking because Devin will be asleep. But that's cool.
This guy is unironically making me wake up at 7:30 in the morning because I got to get my ass to the office and then I got to sit down. And can you believe that, chat? I don't even know why I'm like, I'm really interested in the subject. I literally have to get up. This show is going to be at 9 a.m. PST.
Yeah.
I can't believe it.
But, so Brian doesn't. Somebody asked
tough,
Brian,
Devin.
by the way, what's your Twitch channel? You don't stream right now, right?
I don't stream.
I know you don't get up at 9, Brian, because I know the guys at Twitch don't have to be in the office till like 11 or 12, and most of them aren't.
I am in the office at 7:30 in the morning, Devin.
What?
No joke. It's the quiet, peaceful time where I can get my real work done, following Evan's rule. Get your most important stuff done first, and then I can have my stream of 10 meetings.
Yeah. Oh my God, meetings are.
You don't even know meetings, Devin Nash. Like
that's not true. I ran a company with 100 people, and meetings were. But do you think it's worse? It is worse. You're right.
Yeah.
Actually,
you've seen my calendar. I brought it on your show.
Yeah, it actually is insane.
That's like my Iraq,
Ethan,
my Afghanistan.
Until I'm scheduling when I'm pooping. Then like, and that's what like I've seen Ethan have to do on his calendar. Ethan unironically has to schedule when he's pooping because he has so many fucking meetings.
Has put bio breaks on.
Yeah, like that's so. Yeah, you do win that contest pretty hands down, dude.
Yeah, that's sad but true. Like
because that is actually insane. And that's no word of a lie. That's actually crazy. I'm not even close.
All right, so for our stream, we're gonna warn you. Like Zoom's gonna blow up any second,
but I will be fast as a speedy
and we'll be right
Gonzalez.
back when it blows up. So we're gonna take like a 2-second Zoom implosion break here in a minute.
Yeah.
But meanwhile, we distracted on the save enough. You basically said use an online calculator to figure that out.
Map out your top 5 risks and save enough for each of them using online calculators. So another one is just health risks all up. You can be knocked out by a major health event.
All right. So, of course, it went boom. We'll be right back. But health is good, right? We'll talk about that. And we'll fix Zoom for the next time we do this. We're just not bothering to fix it live on the fly because we normally only do one-person Zoom. So here we come back. Devin's so smart. He's great. Join with video
and
computer
Zoom.
Audio.
We are literally giving so much value to Zoom through this, dude, and like they can't even be fucked to. Yeah, well, we didn't ask, but you know.
Yeah, but we should definitely we should go rage at Zoom. Of course, they're going to tell us like you're getting all this value. Well, whatever. Yeah, they're going to counter
premium. Yeah.
Yeah, they're going to be like, you don't have $15 for this? Come on, you're using us for 4 hours. What's up?
What? We are actually providing so much money in earned media for them right now.
That's true.
It's actually way in their favor, I think. Yeah, because this is free advertising.
Well, yeah, we could go network. I mean, I'm sure one of us knows someone at Zoom in our network, so we could.
Yeah,
go
but then we got to follow Brian's value of time advice, dude, because we're getting paid X. So should we really for the $15 it's going to cost us?
Spend it.
Yeah, is it really going to be worth us both to do that?
Chase the free Zoom
phone call with Zoom and be like, hey, can you sponsor our $15 show? Yeah,
this is like legit, Devin. That's exactly how I think about these things. We could spend $15, or we could think about spending 15 minutes. Now, 3 of us spending 15 minutes, I would pay the $15.
Yeah, me too. I think that's very smart.
So what about I got a question. Some people have asked about using I don't know, different financial management software to help them make good decisions. So whether it be Mint or Wealthfront or Betterment or fill in the blank. Do you have an opinion on any of that for individuals? Is there some money management software that can help you make better decisions or get control of your debt? Or
this is one of those cases in which the difference between not using and using is far more important than what flavor you choose.
Okay.
So I use Mint. How I happened upon Mint, I probably was a sucker for an ad 10 years ago, but it's worked for me in terms of tracking my expenses and tracking my income.
I use Mint too. Yeah.
Yeah. So, you know, do what works for you. They have
There's some things that
slightly
drive me
different-
crazy about it.
Yeah. For me, it disconnects accounts randomly.
For me,
So-
if I'm trying to pay somebody in like some weird currency, they don't convert it to US. It's like, you paid this guy $900, and I'm like, no, I paid him in
Rupees.
in potato coin, and like it doesn't know. So
Right. Yeah. So, each of them have their warts and they have slightly different value props, but they're effectively doing the same thing. It's better to track what you're doing than not to track what you're doing. And the first time you use one of these and start tracking, something is going to pop at you and you're going to think, I had no idea. Be it your credit card expenses, be it the fraction of your wealth that's going to housing expenses, be it how the markets performed over the last year as a fraction of your wealth. I don't know, but you will be surprised the first time you use one of these services. So I use Mint, Betterment, take your thing, but use one.
Your essence of your point is use one of these tools because having something that tracks and quantifies your money is a lot better than what you tell yourself in your mind without the data, right?
Yes.
I completely believe that.
It's a cheap way of tracking it too. It's not you having to manually enter things into Excel.
Yeah.
So it's the cost of you giving up your data. That's a price I'm willing to pay. Maybe you're not. You need to decide for yourself.
They already have your fucking data. The banks sell it. The fucking phone company sells it. Everybody sells it. You just this data thing, this privacy, like, well, my privacy. I never understood that argument. Your privacy is gone, dude. It's 2020. All right, like it's gone with the freaking. Go get your corded phone. Okay, go get your fucking your wheel. Right, go get your candles and get the fuck
your
out of here.
tinfoil hat
This
too.
is the new
while
age.
you're at it.
Yeah.
So, look, I'm glad you answered the question that way because there's so much you learn from looking at the data where you don't realize you basically, we blind ourselves to where our money really goes and how much can dribble through your hands unbeknownst to you. But I want to ask, there's been a couple questions we haven't covered. One of them, I think, is we have a fair number of viewers, both Devin and I have a fair number of viewers who are not from the US. So they live somewhere else, often in Western Europe, but not always around the world. What, if anything, changes about how to manage your finances if you're outside the US? For example, one of the questions is, well, ETFs, that's a US thing. Should I invest in the US market even if I live somewhere else? That's like one example question, but generalizing, how do things change if you're not in the United States?
Yeah, there are different extremes here. And the first one to think about is whether your money is safe in a bank. In the US, generally, yes. There's FDIC insurance, at least up to a particular level. So you don't have to worry about banks absconding with your money most of the time. You don't have to worry about there being a bank run. You will be made whole. Not all countries are in that situation. So in the US, there's a surprising number of the population that is unbanked, which means they do not have access to a bank account.
Whoa, in the US?
In the US.
Oh, yeah, we talk about it. Yeah, it's
how can that be?
Unbanked.
Yeah, they're unbanked. They're not having credit cards or debit cards, and it's just cash and places that you stash your cash.
So
globally,
Devin asked, how can that be? Do you want to say a
Yeah.
little bit more about that before you go on?
It's more, there's an education level there in how you spend and save money. And some people just never got the lesson that banks are trustworthy.
Wow, that's actually insane.
And I'm waiting to see whether my wife is going to chime in here, but there are certain parts of the country that are more suspicious of banks than others.
What's your wife do?
Well, she does finance. She's worked in a number of finance roles, including managing pension funds. So I think that she probably has more to say on this stream than I do.
Should bring her on.
Well, he offered that. He actually, his wife is also super financially accomplished. We're leaving her out of it for the moment, but But she knows actually more in the like pension fund management world, potentially, because that's her business. So,
So the general point is there are plenty of people who are unbanked, and some countries that's a totally reasonable thing because there is a fear that the bank will either steal your money or the government will take it from the bank. Okay, so these are basics that we typically don't think about, and I hope it doesn't affect many people on the stream. But in that case, most of this advice today is pretty moot, except try and save what you can in a secure place.
super basic advice.
But look, this affects some countries in significant ways.
Yeah. Sorry.
We can move on to the question that you mentioned, Ethan. Should I invest in ETFs?
You talked about banks being safe, but there's I assume related to that, some places have unstable currency. Yep. So I make an asset, I save an asset, that's fantastic. But it's buying power because of, as long as what you have is money that is paper money and is valued in some country, our money actually says, like, backed by the full faith or whatever of the federal government.
I think it says it's backed by God, doesn't it? It's even
because that says in God we trust.
That's how I love, dude. America's
that's
so great.
not legal covenant there.
That's a trust thing. Not.
I'm personally expecting God to come down when shit gets this coronavirus. It gets out of control. He's coming. He'll get. Yeah,
we can have that stream another
time. That's when your Ethereum's
Devin.
going to take off, Devin.
we can have that stream. Which biblical plague is coronavirus is the discussion I'm perfectly willing to have. It's a different stream. But yeah, like some countries, even in modern times, have hyperinflation of 100, 200, 500%. So your money essentially becomes worth 1/4 as much a year.
So there are two ways of thinking about this. One is that most of your expenses are in your home currency. So I'm in the US. I use dollars, not just because dollars is a strong global currency, but because I pay for housing and food and services and all sorts of things in the country in which I live. So thinking about exchange rates, volatility there is typically a little bit less important for the typical individual. Now, there are cases in which countries import and export a lot, and that's going to matter more. But thinking about exchange rate fluctuations relative to another currency, typically less important. But what you're talking about, Ethan, is inflation. So some countries do have histories of either rapid inflation episodes like hyperinflation, or at least it's more of a concern than it is in the US right now. So here we target something like a 2% year-over-year inflation rate. We've missed it for a while, but we're moving back to target. Here, we don't need to worry too much about instability because our inflation is low and stable. In other countries, you need to think about, well, what assets are so-called real assets, stuff rather than dollars, that are going to be safe in times of inflation. So stuff would be, I buy a lot of food and stockpile it. So maybe the dollar cost of that food is changing over time, but I'm still able to eat. And that food still is moving around. Like its price might be $4 versus $2 versus $8, but the price of the food moves around accordingly, and I'm safe. I could sell it back to the market and be okay. But dollars, that's not a real asset. That's a financial asset. So financial assets, they might not be robust to inflation. So their values might move around a lot. So when you're thinking internationally, buying stuff is a good hedge against inflation. It turns out buying stocks is also a decent hedge against inflation because companies make stuff and they sell that stuff at prevailing market prices. But Ethan, to your point about bonds are often not good hedges against inflation because it's claims to future money and the value of future money moves.
We haven't had any discussion about bonds and what their value is in a portfolio, what they even are. Because like bond, what is a bond?
Yeah, what's a bond? A bond is a claim to cash in the future.
That's a very abstract definition.
Yep. So I can go to, I can buy $1,000 at the U.S. Treasury that pays me some coupon. So like a dividend, but on a bond, it pays me like a 2% coupon. So it's going to be $20 every 6 months. And then maybe in 10 years, it will pay me that full $1,000 value plus that final coupon.
Right.
So it's just
but
like
more
a stock.
conceptually,
Yeah.
sorry, just
Go for it.
bonds are, whether it's corporate bonds, which are loans sold by companies, or government bonds, which are loans to the government. Essentially, you're taking your money and you're loaning it to someone, and they're promising to pay you some interest rate on it, plus the money back at some future point.
Yes.
And so we've done a ton of talking about stock and some about real estate. We've not talked at all about essentially loaning your money to other people, which is what a bond is. It's so maybe you can take it from there. What are the advantages and disadvantages of loans versus stocks versus real estate? A little bit.
Yeah. So the primary thing to think about when you're differentiating between bonds, stocks, real estate is the timing of payments and the risk of each payment. So look at a bond. A bond, if you buy a 10-year bond, what that means is that over the next 10 years, you will get this steady stream of payments and then a big hit at the end 10 years from now.
Unless the company goes belly up. Or
unless the company goes belly up.
Yeah.
Defaults, at least in the US, are pretty infrequent. Now, you can look at the government defaulting. That virtually never happens in the US. As experiences differ a little bit internationally, but most countries don't default most of the time.
It's rather hard for them to stay in business after that.
Yes.
Right?
Yes.
Like not paying your loans is even worse as a country or a company generally than as an individual.
Yes. So the way that bonds work is relatively safe payments at regular intervals for a long period of time. So what's a bond good for? Bonds are good for recurring expenses that you know that you're going to have to pay month after month. So for example, a good investment that could pay rent would be bonds, because you know you're going to have a place to live. It's relatively stable value for your rent. So if you had enough money to clip coupons, it's called like collecting the dividend on bonds. If you had enough money, that is a perfect hedge against a very good hedge against your rent. It's very safe, unlike stocks. If you invest in stocks, they might lose 40% in a month or two. Right now, we're on track to losing at least 10% over a few weeks. Your rent payments aren't going down by that same amount. So it's a very bad hedge there.
I need market indexed rent. I have to figure that out.
It's actually, there's a security for that.
Someone will sell it to you. Yeah. There's something out there. Someone will sell it to you.
I'm sure there is.
Mm-hmm.
There's a security.
There are things called Case-Shiller indices, and they track housing prices. So if you wanted to look at the house price in San Francisco, if you wanted to look at the house price in Chicago or in many different regions, you can check. It's a thing. And there's a financial instrument built on top of it. Now, they try not to trade much, but the idea was this would be a way of hedging the value of your home.
Wow. So I'll just say, you just convinced me of something new. I learned something. It's not the first new thing I've learned today, but you just opened my eyes, even though they're closed at the moment, to the fact that there's a financial instrument that tracks everything.
Yeah.
Yes.
If there's money to be made.
Well, or if someone wants that instrument, it can be created. Which actually, well, anyway, I don't want to distract this again. But so I have a question. As a idiot personal investor without your history, I've just simplified, like, bonds are useless because they don't pay very much. Stocks go up more on average per year. have no bonds, have all stocks, because average return on stocks 11%, average return on bonds not close. So
no, you're not wrong, Ethan.
okay,
what you're
my
trying to cast
heuristic is very simple.
Yeah, what you're trying to cast is naive. You're not wrong, and in fact, the biggest single so-called puzzle in all of academic finance is why is the return to stocks so high relative to the return to bonds? So
Okay.
exactly what you're saying.
Okay.
Why are stocks paying on average 10% a year rather than 5% a year when bonds are paying 2%? So that's called the equity premium, the average return of stocks minus the average return of bonds. It's the equity premium puzzle. There's a paper in 1985 that made it prevalent, and it is the single biggest puzzle in all of academic finance.
Well, don't worry. Twitch chat has an answer. They'll know it. Yeah, you should have just asked them. They would have figured it out for you.
This is one of the common threads in finance and anything else. There's no challenge in terms of having an answer. The challenge is having a credible answer.
That's a fairly solid burn, actually.
If none of us had reacted, they wouldn't have known they were insulted.
Damn. Yeah, I didn't keep a straight face. That was just kind of put out there, and I didn't let it just sit. You're right.
And academics have many explanations, but here's what's relevant, Ethan. Here's what's relevant.
Okay.
The prediction is, given how good stocks are in the US, the prediction is that individuals should want to hold more than 100% of their wealth in stocks.
Yes.
So they should be selling other things to buy even more stocks.
Yes.
Obviously, that doesn't happen.
Mm-hmm.
So either we're not understanding some sorts of risk, or people aren't optimizing in some outrageous way.
So for me, that answer is obvious, but I assume it is for you too. Right? Like, for me, that answer is, well, there's plenty of research. I am a bad gambler. And what that means is most people, not all, gambling addicts, I believe, are an exception, fear the pain of loss more than they value gain. So in other words, the idea of losing $50 hurts someone more than the idea of maybe winning $50. And so
Ethan, here's how we fix that.
Yeah.
So what you're talking about is loss aversion.
Yep.
Or there's risk aversion. That from your explanation could be either one, but the idea is losses hurt more than gains.
Yes.
How you fix that is you never check your portfolio.
Yes. Oh my God, that's
or you
so
delegate
smart.
it out to someone else. So for a lot of behavioral quirks, so behavioral being a buzzword for, we have all sorts of heuristics that aren't necessarily rational behaviors. You should be able to give it to someone else who is rational, and they should be able to work around it for you. So how do you get around loss aversion? Well, if you're concerned that you're going to feel really bad when the market hasn't done well this month, don't check your portfolio for a year, because you're saving for retirement. What the market does this month isn't relevant anyway.
Yes.
So that explanation doesn't go that far. But you're right. This is well documented. This is one of those behavioral anomalies that is well understood. People hate losses. There are all sorts of pathological behaviors associated with that. But that doesn't explain why stocks are so good.
Okay, so that doesn't fully explain it.
Right.
Okay. So what? I mean, is there something else that does? Or Devin, did you want to jump in on that?
Hell no, dude. If he's been to Harvard and the University of Chicago and Duke and shit, if he doesn't know the answer to this shit, I'm not gonna fucking guess. I have no idea.
So it's just you really mean it's an open mystery, like the best academics don't know why.
So I can speak to myself here in terms of my financial asset portfolio. I'm 90% stocks. And if you look at Vanguard, if you look at life cycle portfolios at Vanguard, Fidelity, anywhere else, if your retirement is more than 20 years away, every one of them is going to have something like that. So like the 60-40 advice, that works for like the average person. But if you have a lot of years to retirement, it's almost all stocks, a little bit of bonds.
I mean, like, when you say it's almost all stocks, you're referring to ETFs in that mix.
Yes,
'Cause
or mutual funds, either one.
Yeah.
So some diversified basket. Speaking to Vanguard, because this is what I know, there's some diversified basket. There's U.S. stocks. There's international stocks. That's something like 65-35. And then there's U.S. bonds. International bonds are like 7 and 3. And that's common.
Yeah, and I guess I none of us are here to discuss our personal portfolios, but for better or for worse, I'm 0% bonds, and I own real estate, which is my proxy for something that's not equities.
Yeah,
right. The like stable asset, and again, I've oversimplified, but the idea of making three. Again, it's exactly what you said, and this is, I guess, the first time I'll say something personally for the stream for everyone. If you can weather a downturn, if you can either not look at your portfolio, or when it's down, realize that one day it will go up again, then stocks are the answer. But what happens, and this is where we haven't gotten into this, like the psychology of how individual investors screw themselves, is they invest in stock and then it goes down and then they sell because they're afraid and in pain. And then what they've done is they put $100 in and it went down to 60 and they sold it. And then when it goes back up, they buy back in, only they can't buy in $100 worth anymore. They can only buy in 60. And like the sell on the way down, buy on the way up is like, we talked about how market timing is a bad idea. Brian, maybe you have a lot more, like I'm babbling about this. Maybe you can crystallize it, or maybe Devin can.
Well, I want to
But people screw themselves.
Yes.
Yeah. I want to add another take too here is that just real quick on the previous point, it's not the only investment strategy to invest in stocks or real estates or bonds. The other thing you can invest in is your own self and your business. And
That's
so,
right.
for example, I put quite a bit of money back into this stream every month. And I do it proportional to the amount of donation subscriptions I receive. And that's because my business is an asset, right? So in the same way that I can make money from stocks, if I put more money back into the production quality of this broadcast, if I put more money back into the the team, the people that work with me, then I am increasing the value of that asset. And I would argue, and this might be something that the finally one thing on this call that I actually might be able to be qualified to talk about, and having run businesses all my life, I would argue that is usually going to be exponentially more valuable than something you can do in stocks, for example. Because if your stocks are going up 10 to 20% per year, your business can, if you sell your business, right? If I put money back into our agency, or if I put money back into my broadcast, and then that becomes a source of exponential value, and I'm the next XQC, that's going to be a percentage of value way higher. So don't limit yourself in your thinking just on investing in I guess what you would call like asset classes, right? Like just like financial asset classifications. And think about, can you invest in your education, right? And I'm not talking like student loans. I'm talking about, can you take a course? Can you take like can you read a book, right? And think about things that actually exponentially value, because the only thing you're going to take with you is yourself ultimately, and in the long run.
It's the same reason education is so valuable, right? Because once you're educated, like no one can repo your degree.
That's right.
Like theoretically, your house can be foreclosed, your car can be repossessed, your job, you can be fired, but your education, as long as you're alive, can't be repo.
I think he's gone.
It's
I'm still good.
Buddy. We're in this together now.
Coronavirus
got him. I did. Oh, dude, that was insane, dude. Brian and I just literally just had the the bromance moment.
Wow,
even.
I can hear you both, but something I don't know.
No, you're fine. We can hear you.
You're good now. Yeah.
Yeah. I'm like, we literally just said at the exact same time. Coronavirus
but I died.
got him.
Yeah, thanks. Damn it. Yeah. I'm out of here.
That was insane.
I have no idea why that happened. Thank you, Comcast. I guess.
That's why it happened. Yeah.
Yeah. Either that or
Yes,
I have stepkids who love games, so we got overwhelmed by the startup of the next game.
Right.
So
yeah.
all right. So let's do something else that'll be fun for Devin and for you might say we're being baited here, but I'll word this in a non-baited way. How much if we put on our tinfoil hats a minute, as an academic, how much do you believe that the financial markets are manipulated by fill in the blank? Wall Street firms, the Illuminati in Switzerland, governments.
George Soros.
Yeah, like fill in your favorite villain. Because Chad is asking, like, for example, is there a magical team on Wall Street that when the market goes down too much, does whatever it is, releases money, changes monetary policy, and makes sure that the rich get richer and blah, blah, blah. So take that question any way you want and talk about conspiracy theory on the financial markets.
So mostly no, that's crazy. Conspiracies of that scale are hard to keep quiet. So I would say, no, you probably don't have anything to worry about there. There's no secret cabal that runs the financial system.
He's part of it.
I'm part of it.
I went.
Yeah, clip that out of context. There's a secret cabal.
Yeah, because
it's
he said
very
there probably
hard.
is no, and then if you clip from that point, secret cabal that runs Wall Street, it's right there.
He literally worked for the you work for the futures exchange.
Yeah, commodity futures trading commission.
Yeah, dude. If anybody's in the Illuminati, it's you. So of course you'd say that. I think there's an Illuminati chat. Yeah.
Look, it's hard to manipulate the price of a particular stock, much less the entire market. And
what if you have billions of dollars?
How big is the market, Devin?
Trillions of dollars.
Tens of trillions for a U.S. stock market.
Mm-hmm.
So if you've got billions of dollars, you're just a drop in the ocean.
But that's not the individual. Okay, but there are individual hedge funds that manage $1 trillion.
So they do have what's called market impact.
Mm-hmm.
But the thing about market impact, so when you move the market, how does it work? So I am buying $1 trillion worth of stocks. So I went from zero, I'm moving from bonds into stocks.
Okay.
Stock prices are rising as I'm buying. So I am paying more and more for the same thing.
Oh, that's true.
That before used to cost
really
100,
smart.
Now it's costing 110. It's hurting me.
Yeah, that's true.
So
I never thought
you're
of that.
basically saying they're selfish and wouldn't do it because
they're selfish and they don't want to do it.
Mm-hmm.
So there are massive components of the financial system that are dedicated to minimizing so-called transaction costs, of which market impact is a part.
Mm-hmm.
So you wouldn't do it that way. But I say this with a caveat. There are, of course, mechanisms by which, say, the Federal Reserve can be effective. So when they cut interest rates by 50 bips or whatever it was last I checked, that does change asset prices because they have a balance sheet plus credibility that's large enough to affect the aggregate stock and bond markets.
Mm-hmm.
In the US, the government does not directly intervene in stock markets. That's not always true internationally. There was a sequence of so-called mini crashes in China a few years back. It was January of, I think it's 2016. Someone can probably check me on that in the chat. And the Chinese government was involved, effectively coercing state-owned enterprises to act as an arm of the government in the stock market. So that was called the home team, or something akin to it. So there are sometimes large-scale interventions, but not here. That would be the sort of scandal that would make the news.
So you don't think that like Bridgewater or like Ray Dalio's hedge fund or something like that they have the power to actually manipulate an individual stock? Do you think that happened with crypto?
Oh, that would be a good topic.
Let's
crypto.
let's set crypto aside for a moment.
Oh, he's dodging it.
He just said
blah,
yes in code.
blah, yeah.
So,
Blah, yeah. Boo!
so look, I'll speak to something directly that I know, and
Okay.
then we can talk more
Speculation.
speculatively. So directly, what I
am
know
Twitch-chatted.
is you can cause flash crashes. That's a thing. So has everyone heard of flash crashes? Should I explain that
Yes,
quickly?
you should explain it. Yeah.
Yeah. So what's a flash crash? Is a very sudden decline in the price of a stock or an index, or a very sudden rise in the price of a stock or an index that isn't really explained by fundamentals. And it reverts within a few minutes to a few microseconds. So these things have a horizon that's short.
Mm-hmm.
So if you've heard of the flash crash, that was an event in May of 2010, in which the S&P 500 came down about 10% and bounced back most of the way within 15 minutes.
Wow.
So if you were a trader and took a long bathroom break, you missed the party. But these flash crashes can happen. And the initial story, and I can't confirm whether this is the exact right story, but the initial story was you had a large investment manager that was selling $4 billion worth of index within a very concentrated period of time. And if one were to do that, you could move the aggregate market. Now, you would lose 10% immediately as the investor, like is the easiest way to lock in a loss, but you can move prices. And there's a lot of concern about high frequency trading, but something that is true is that markets are thinner than they used to be. It's easier to move prices than before.
Sure. So
but those disruptions last for less time.
Less liquidity, all kinds of like that. That's a huge other.
Is it true?
It's arcana.
Is it true that they have like that? Some of these people set up like these giant fiber optics lines to like trade like a split second faster, so they can trade on top of regular market decisions. Is that a meme?
It's a meme because it's true. I mean, it seems almost comical. The curvature of the Earth matters.
Holy shit!
So there's this actually you may be better at saying this, Brian, but since I come from a networking background, there was actually this thing where all the high frequency trader firms, all of their hardware is in Wall Street in the same place with the same amount of cable.
Yes.
So that none of them has an advantage. They're all like the stock exchanges basically said you all go in this one place.
Oh, so they regulated it.
And they
no, they didn't regulate it, but it was kind of automatically regulated. It was important to make things even. From the perception of the people who were sold access here. Ethan, sorry, I'll let you finish this.
No, it's so weird. Like to the degree that my rack was 5 feet closer to the trading floor than your rack, they put extra loops in my cable so that my cable distance is exactly the same distance as yours, so that there is no advantage at all, is what I'm told.
That's exactly right. Because that matters. And that's called co-location. So the picture that most of us have of stock markets is something you see in old movies of really loud people shouting at each other and saying, "Oh, this," and all these weird hand signals.
Yeah.
No. These trading floors are mostly shut down or on their way out. Instead, most trading occurs. There is a server sitting quietly next to a bunch of computers, and they're sitting in a hallway together with the cables finely measured out so that someone doesn't have a microsecond advantage on someone else. A microsecond, by the way, is 1/1,000,000th of a second, and nanoseconds or billionths of a second matter too in today's markets. So what matters there, besides the orders of magnitudes that are kind of eye-popping and cool, is if you think that you can act faster in response to information than anyone else in the financial market, you're totally wrong. Okay, so you as a human, the time it takes for you to blink is measured in hundreds of milliseconds. So thousands of a second. So we blink pretty fast. I just blink, it's gone. These computers operate 6 orders of magnitude faster than that in some cases, in terms of how they respond to information and route their orders.
Dude.
So our whole financial system, what you just said there, in a way, is our whole financial system is based on faith and trust, in that you could take what you said to believe that like the individual investor or the individual person has no hope of anything. But in fact, generally, standard of living across the world is rising. So despite the tinfoil hats, the news is generally good.
That's right. And the right way of thinking about this is, for most people, high frequency trading has been great. So full stop. Mom and pop are better off in most cases because of high frequency trading. Why? Because when they trade, back when I was growing up, it would cost, say, a quarter for the bid-ask spread. So that's the difference between the price at which you buy and the price at which you sell.
Oh.
So you had massive trading costs.
Now
you have a fraction of a penny.
It's also kind of crazy that a bunch of even Charles Schwab, I'm very surprised, just eliminated their transaction costs.
Yeah,
like you want to trade, it's free. Yeah,
it's free.
Like it's nuts. Yeah,
is
that a byproduct of that?
Yes, absolutely.
Wow. Interesting.
And that matters in that, I do have a portfolio of individual stocks in part. And if you're buying across them on a routine investment basis, the fees used to add up and now they're just all gone.
Yeah. You used to have to calculate the fee. Like if you're going to make a trend, you'd have to calculate the fee into your gain. You'd have to be like, if it costs me too much to trade, like that was a big thing for day traders, right? Like I'm going to go trade 60 times. It's like, okay, it's $4 a transaction. And it's like, oh, I better make my money back.
That's just a tax. It's a tax on,
right.
That's
right. And I guess they got eliminated because like pretty much everybody had to be competitive once a few people in the market got rid of them.
Well, and that's the word, Ethan, Devin, competition. It used to be there's effectively a racket. And one of the biggest papers ever in finance was discovering there was a racket. It was called the odd eighths. So you were allowed to quote in eighths. So like 16 and an eighth, 16 and 2/8, 16 and 3/8.
Yeah.
But people were just quoting at 1/8, 3/8, 5/8. Why? Because there was actually a cabal.
Holy shit.
That was orchestrating against retail investors like you and me that made, instead of paying 12.5 cents, you're paying a quarter.
Wow. Drop those people in the ocean. Devin, you're on top of the fact that Zoom's going to blow up again?
Bro, I am all over it,
all right,
man. We're about to... we could just end it now and I can send you it just so we don't get interrupted.
Yeah, because I want to hear more about this cabal.
Yeah, I do too. All right, I'll be right back.
Cabals are fun. All right, we'll be right back. We'll do one. I think we'll do one more Zoom worth of content, and then we might call it, because it's been a long stream. So I'm waiting for this to come in. There it is. La, la, la. Lots of buttons to click. I have to it's like 12 things to rejoin here. All right, we're back.
Yeah, we're back.
It's cabal time. So tell us about the cabal. That's incredible.
Yeah, so I'm going to post something to your chat, Ethan. So if you could let the link through.
It's gonna block you. Oh, there
it's also my chat.
Oh, staff can. I think your staff privileges solve this problem.
They do not.
Oh, really?
Wait, what? What stops you from posting?
I have links disabled,
and that stops you for staff from posting a link.
But
links, links have to be moderated in this channel. That's right. So,
Ethan's got some crazy, like Amazon level, security on there. Cause no, it wasn't your stream where Boner got banned. That was the other stream we're on.
That was an Amazon corporate stream. Yes.
Yeah. We had an Amazon corporate stream, and one of my mods posted Boner, and then it got banned. It was fucking great.
So there was actually.
So what's it? This is The Economist here.
Yeah. So this is old article 20 odd years ago.
Wow.
And
bastards.
They colluded against the public, and they made trading costs twice as large as they ought to have been. So this was, The Economist calls it $1 billion paper, probably more than that. But the idea of having a small number of brokers in the market able to collude, that's not possible anymore. So with high frequency trading and with, in general, advances in trading technology, the markets have become competitive enough that you didn't have to be one of these 30 who are trading in the market and can talk to each other. Anyone who could buy the hardware, the networking stuff, have algorithms, anyone who had the collection of hardware, software knowledge could compete to provide liquidity in markets. And that compressed the cost of trading dramatically. So robots, if anything, made life a lot easier
and
for
a
most
lot less
people.
likely to be colluded on.
Well, because
that's actually crazy.
Again, being old, like there were a finite set of seats on the physical stock exchange.
Yes.
And they used to be auctioned. So like if you were a bank and you wanted to go into trading stocks for your bank, you had to go find some other bank and pay them enough to give you a seat.
Sorry.
So
and Ethan, there's a funny story here in that bonds used to be exchange traded by and large. So if you go back to the 1920s, corporate debt was traded on the New York Stock Exchange.
Wow. All right.
Why did that stop? Well, it stopped because in the 1920s, trading stocks was where all the action was. So that fixed number of seats went to people instead of trading bonds who were trading stocks. And there wasn't a new exchange built at the time right away to trade bonds. So it was because of that fixed number of seats, in part, that bond trading moved from a simple infrastructure like we have for stocks to one in which you still, to this day, make phone calls much of the time.
Huh. Wow.
So that had a dramatic and century-long thus far change in how markets are structured. That simple feature.
Wow. So chat's saying there have been a bunch of other manipulations and scandals in other markets, right? Precious metals, and I believe that's completely true, right?
Yes.
In other words, and we haven't talked about exploitation schemes either. God, I can't think of the guy's name now. Is the pyramid scheme guy, the last guy? Madoff. Yeah. I fucking love that, right? Like a thief whose name is Madoff. Like I made
That's
off.
That's the guy you want to trust with your money.
Yeah, I'm going to give all my money to Madoff. Like
yes.
So I guess the point is, right? If an investment sounds too good to be true, it is. And beware, right? Like beware of where your money is being put. Yes. And ask questions, and don't put it all in any one person's like instant overnight wealth scheme.
No.
So we could go on and on about that, but I guess the real point is, yes, there have always been thieves. And there will always be more clever people figuring out how to steal. So that's a risk.
On that note, I'm going to duck out for just a moment.
Yeah. So perfect. Devin, while he's gone, I was thinking we go to the end of this Zoom. It could be like our countdown. For how long, I don't know how long you want to go, but we've gone a while. But what topics, why don't you and I have a talk while Brian's out? What topics do we want to cover?
Let's have a talk, Ethan.
What's up?
Let's have a talk, Ethan.
Let's have a talk. What do you want to cover that we haven't?
Chat, is there something that you really want to know about finance that, or about these subjects that you think we haven't covered on this show so far?
Yeah. There's a vote for real estate over here. We did talk about it a little bit, but we didn't talk about like
we already
corporate.
Talked about debt. You got to go back in the episode for that. Loans, capital gains tax. Okay.
We haven't talked about taxes at all.
I don't know if it's really. I want to keep it like relevant to the vast majority of the vast majority of people here. I do want to ask him So Hephaestus said I do want to ask him if there is one really big thing that you could remember from this show, what would it be? 100 bits of emerging markets. Okay.
Pensions, I see mentioned.
We brought that up already.
A little bit.
Yeah.
Although we really just talked about how pensions are fiduciary, right?
Mm-hmm.
We also didn't talk about dividends. Other than in passing.
Yeah, so stuff that's really important to, I guess this falls under his category as a finance professor.
Okay.
Do you think we could talk about making more money?
Ooh.
In the sense of like what kind of things you can do in your life to actually physically make more money that you can then leverage into things. Because we mostly kept the finance talk to like investment stuff.
That would be clever. Like,
yeah.
I don't know if he'll feel he has a lot to say about it.
If he doesn't, he'll say that.
But
I'm sure he teaches about it, right?
Yeah.
Mm-hmm.
Let's bring it up. Like increasing personal earning power is your point, right?
Yeah,
making more money.
By the way, real quick, dudes, I'm co-streaming this with Ethan. So !Ethan in chat is twitch.tv/Ethan Evans. Ethan does a lot of really cool stuff like this on his channel. So please toss it a follow.
And I assume everyone knows Devin Nash, but for my channel, if you don't, Devin Nash is my good friend. We stream a lot of things together. We brainstorm together on what to stream. He's /Devin Nash on every possible surface, even TikTok.
Except Instagram.
Yes. Oh, I saw you. You were so butthurt that woman Maya got Instagram verified. Yep. That was like fun. It was fun. That was your best React video ever.
Oh, was it?
Well, you being like, how did you get verified? It was so authentic.
Yeah, because it's bullshit. I run a fucking agency and I can't get verified. She just applied. I have no idea how she did it. It was ridiculous.
I appreciate all that. You sent me a ton of followers, though. Like the follower stream is going crazy. So thank you for that.
Of course. I wanted to make it. So I have the real question. All right, Brian?
Yeah, I'm here.
This is the hardest question you're going to get asked.
Go for it, man. How
the hell did you manage to get a Twitch meeting room for 4 hours?
This is our broadcast room, and right after you guys booked me, I reserved it. So
that's amazing.
You're right. Getting Twitch meeting rooms is challenging.
I have had meetings canceled on me with Twitch people just because they can't find a room.
I believe
got
that.
Phones, don't they?
Well, they can't like talk at their desk because you know the work. I mean, are you at the San Francisco office?
I am.
Yeah, you can't talk on your phone at your desk there because there's someone next to you like 2 inches away. Yeah, it's crazy. Are people working there right now? Like, or is it like the virus scare?
Yeah, folks are still working here. Folks are still having dinner. You know, office is still running.
Office life. Yeah, that's crazy.
Yeah, I'm the other end of that. Before we go into the financial questions you want to ask, because Ligerbox, who brought the virus expert, just showed up in my chat. It's good to see him. Devin and I are going to do a stream Monday morning at 9 a.m. with a virus professor, an expert from Columbia, Dr. Vincent Racaniello. But I'm the one working in the office. I'm in Seattle. Devin's in Seattle too. King County, which is the Seattle, it's Monday at 9 a.m. is when we'll do that stream. 9 a.m. Pacific.
Can't believe Ethan got me to wake up for this shit.
Yeah, you don't have to come, man. You can watch from home and I'll do it. Like I offer you.
The community. I'm not gonna. I'm gonna stiff everybody in the community now because like they want me to. What?
Just send them over to Ethan's channel.
It's true. They won't go, but yeah.
Harsh. Wow. So anyway, coming back to this though, I'm the one who's working from home for the next month. The advice King County put out, which is the county for Seattle and Bellevue, where Devin is that everyone who can work from home should roughly.
Washington State just had a press conference that actually everyone in the state should work at home. And
did they push it to statewide?
It's 5 p.m. While we were talking, they had a press conference, and and it's they also declared a whole state of emergency, and it's all a big thing. And Chen was out shopping for toilet paper, and like I can show you if you guys are on my stream, I can show you the picture that she posted.
It's all gone.
Yeah, it's actually unreal. Yeah, it's like everything is completely, totally gone.
Yeah, the fear factor. It's interesting. I like to make predictions.
This is Seattle right now.
I like to make predictions, and I made the prediction over the weekend. I was talking to my wife and kids, and I said, I'm betting I'm going to get a work from home email Sunday night, and I missed it by 3 days. I missed by 3 days when it would come.
Are you still going to the game?
Well, if it happened, I think so.
God, you're crazy. Literally the whole state is saying don't be in a crowd of 50 people and you're going to a game with 10,000 people.
Devin, it's not going to be 10,000 people. It's going to be 50
that's pretty
people.
much how I'm looking
Because a
at
lot
it.
of
It's
people are
going to
gonna-
be 50 people.
You think everyone else is not going to go?
I don't know.
What if everyone else thinks that no one else is going to go and they all go?
So what Devin and I are talking about is it'll be interesting what chat thinks of this. We'll see what Liger thinks, since we have at least one virus expert in my chat. I'll relay it. There's a soccer match in Seattle, and at a charity auction, we bought access to a box, and we've arranged with a bunch of our friends, including Devin and his girlfriend, to share out that box that we bought at a charity auction as
the
a
Sounders
donation.
game, soccer games, the
Soccer
team.
game.
Yeah.
And
Sounders
so the way I look at it is like I'm around 10 people I know, which they're not 50,000 people. But and Liger's protesting, saying he's a bacteriologist, which is hard to pronounce. But you're stuck with being viral today, Liger. How insane is it to go to the box seats in a soccer match? It is borderline insane. I actually am not worried about it yet, Devin, because I'm not sure they'll be able, like, with all the advice, I don't think it's happening.
They can't cancel it because the refunds would be insane.
Well, like in Japan Japan is playing baseball in front of empty stadiums.
Yeah.
Europe is playing soccer matches with no fans. Like Italy, they hold the soccer match but no fans. Liger
They just canceled they just canceled my UW talk. I was going to give a talk over at UW over the weekend, and they shut the whole thing down. Yeah, so I'm not doing that.
So the other thing to be fair about, and then we'll go back to financials, is Devin is a self-professed germaphobe. So like I had a sniffle. I was planning on being in his office, and we were going to do this at a studio show.
He has coronavirus right now. I know it.
But yes, according to Devin, I have coronavirus. According to me, I have a sniffle. But I respected his wishes. And
my various witches that I keep on, to cast spells to avoid the germs.
Yeah.
Yeah.
So Liger's being super encouraging because I'm 50, not 80. He says even when I get the gigavirus, I'll live.
Oh, dude, that's not true though, because a lot of people have long-term complications from the respiratory illnesses. Like I feel like that advice is very bad.
So to be fair, you have no idea what long-term, like, how could you know? It's been like 2 weeks. No one has any idea what complications.
People's lungs are being permanently damaged from the respiratory effect that comes off of it. It's immediate. It's not. It's long-term in the sense that it affects you for the rest of your fucking life.
I don't know. Maybe. We can talk to the virus expert.
It's a
Ethan,
really.
you just want to go to the game. You're going to believe your own facts here.
You're crazy.
Well, that's true.
Yeah, you're crazy.
I do have confirmation bias.
Also, you're sick right now. So at the very least, you're gonna get everyone that goes with you sick.
Says I'm spreading. Somebody's spreading wrong info. So please stop. I don't know who that is.
Is it me? Let's ask the virologist. We got the guy coming.
All right.
On Monday.
Yeah, we'll ask him.
We'll put the question. Yeah.
Oh, Liger says you get permanent damage from influenza too. So
True.
he's basically saying
That doesn't discount.
You're only getting regular permanent damage though. So like, live with it. Anyway, let's go back to financials. What did we agree to ask Brian while he was gone?
So have a few things. Brian, this is an optional question.
Go for it.
Okay. So, we haven't talked at all about the concept of literally making more money. Is this in your wheelhouse? And like how you think about that, how you do it, any type of stuff like that?
Yeah, does that cover, is your expertise in like if I want to increase my personal earning power?
No, I have no special information there.
Good thing I have other questions. How about dividends? What's the deal with those? And like as a normal investor, how can we dividends? Good luck.
So you need to think about why you want dividends. So first off, just to define dividends are a steady stream of cash that is paid coming from an investment. So it's literally called dividends from stocks. From bonds, it's called coupons. It's just something that's spun off at a regular rate that has a near fixed value. So companies adjust dividends infrequently. For dividends, we need to be a little bit careful. And are we actually married to the idea of a dividend or the physical thing dividend? And by that, I mean, there are waves of tax treatments that lead to retained earnings that look an awful like dividends in terms of how they increase stock prices, but they don't pay out as a dividend. So the reason why you want a bona fide dividend is you want to collect your cash and pay down something that has a recurring liability attached to it. But a lot of companies don't pay dividends, as folks have noted in the chat before. So a lot of them just retain their earnings. And whether that works for you depends on whether you like being paid in terms of price appreciation, so prices going up, or whether you actually want that fixed payment to counteract some other fixed payment. So the only case in which you truly deeply care about dividends or coupons or what have you is if you do have fixed payments or fixed obligations. So for pension funds, for example, you have people draw down at a regular rate and you need to be producing cash to pay them at that regular rate. Cash that is relatively fixed, cash that is relatively certain.
Makes sense. Yeah, I actually understand it. Ethan?
So is that like,
you doing good?
Well, I was just wondering, is that like simplified? What I heard there is dividends good in unique cases like bonds good, but generally not that good.
So most of the time, you shouldn't care whether you're paid in dividends or price appreciation. So what you care about is the return on the stock. Is the stock giving me, in terms of the value of the stock plus the cash, is the stock giving me 5% or is it giving me 20%? I don't necessarily care if that 5% comes from the price going up
dividends.
Or from the dividend.
So I've always heard, though, like the way I've looked at it, whether it's fair or not or true or not, is dividends are what a company does when it doesn't have a better idea for its own money. So that's like a little bit arrogant, but basically you'll notice no tech stock ever pays dividends. And it's because whether they're arrogant or not, they believe that they have an investment for their money. Like they'll go make a new tech, which will, whatever, right? We'll rile Devin up and we'll say, Elon Musk, when he has extra money, like builds flamethrowers or hyperloops or something that he thinks will make him more money. He doesn't pay out like a little bit to each shareholder. And the companies typically that pay out to shareholders are like utilities. Like I am the monopoly for, regional gas supplies in Fu District. And I can't do anything with the money I make except pay it out to shareholders because like I can't innovate. So I see you nodding. Is that basically right?
That's basically right. I don't think, I guess I would remove the judgment aspect from this.
I have to admit, I was feeling very superior and it was pleasant.
But the idea is exactly right. If a company has
how can I be exactly right, but I can't be pompous at the same time?
He said the idea is right.
Oh, the idea is right.
Yeah.
If a company has $1 million and the investments that are internal are giving 4%, whereas the market, if you gave it back to investors, would give 5%, then you destroy value when you decide to invest internally. So the mandate for companies that are accountable to shareholders is to maximize shareholder value. So they're supposed to look at that 4%, look at the 5%, and say, I'm not going to keep it inside. I'm going to give it back through dividends, through share buybacks, things like that give the money to investors rather than keep it in-house for the investors to decide what to do with.
Okay.
So it's not a judgment of the company. It's a judgment of what do they do with that next $1 million.
Ooh, hey, there's a good question. If we're Devin, did you have another like power question? He's busy.
My girlfriend just came in with the dinner. Hang on one sec.
Got it. Yeah, I probably have dinner downstairs too, and I bet Brian wants dinner. So we'll end when this is over. He'll go eat. So Brian, one of the coolest things I learned about, since we were talking about personal finance, is the doctrine of marginal utility. Is that it was explained to me very simplistically as the value of getting your first dollar is worth a lot more to you than the value of getting your millionth dollar, because your first dollar you have a real use for and your millionth you don't. I don't know. Is that relevant here at all or not so much?
It's absolutely relevant. And the way that's financially relevant is the following. If you are scraping by, you desperately want that next dollar because that goes to food, shelter, clothing, etc. If you're not scraping by and you're doing okay, it's good to have more money, but it's not the difference between subsistence and not subsistence. So absolutely. And that dictates how you can invest versus not invest. It dictates the type of investments in which you're willing to take. So for example, if I'm just above subsistence, I'm not going to be investing my cash in stocks.
Too risky. Might starve.
Might starve, because if stocks don't do well, if we have an episode like the last 2 weeks, that means that I can't get food. So yeah, absolutely. And this is one of the fundamental assumptions that undergird pretty much any economic model. There's so-called curvature to your utility, where the first dollar is worth a lot more to you than your later dollars. And from that comes things like risk aversion.
Right. Okay. So marginal utility ends up controlling your risk aversion, which in turn controls your ability to be long-term and to maximize profit. Like, these are all connected.
Yes.
Sweet. Okay. I've learned more. I keep learning. This is good. All right. So, Devin's already eating. I need to eat. We need to free Brian it's like Free Willy. We need to free Brian at some point. Well, Brian, is there anything someone wanted me to ask? Is there anything you wish we'd ask you, or that you really want to talk about?
Yeah, that's a really good question. Mm-hmm.
I think there are 2 items. Hey, that looks healthy. You're spending your budget on food.
I told you, dude. This is actually expensive as fuck too. This is like, man, it's because I've got a podcast I got to do in an hour after this, right? So like, this is my only option. Like, yeah, that's pretty crazy.
Yeah. So there are 2 things, and we talked about one of them some, and that's just benefits of diversification. So as a finance guy, I can't not talk about that.
Diversified portfolio.
Yeah. Diversified portfolio. It's the idea. Don't put all your eggs in one basket. In general, you're not rewarded for concentrating your risks and putting your money in the same place.
Interesting.
So there are smart risks and there are less smart risks. And in general, less smart risks, like being under diversified, like being massively into one asset like Ethereum, Devin, that generally is incredibly risky and doesn't change your expected return. So you're not compensated for. It's not a good thing to do. So in financial markets, there are better ways of diversifying for cheap than ever before. We've talked about ETFs. We've talked about index funds broadly. Use them or use something like it. So the second point that is salient today is thinking about, is recession around the corner and what are the effects of coronavirus? And the short answer is nobody knows what's coming next, but there are plenty of signals. The yield curve inverted recently. So what's the yield curve? It looks at the returns on bonds over different time horizons. So when the yield curve flips, what that means is that the typical relationship between you get compensated more for long-term investments, that inverts. And what that is a signal of is bad times ahead. And that's something that the financial market kind of in its collective wisdom agrees upon. So financial markets are suggesting that bad times are ahead. Of course, you see volatility in the markets. Volatility goes up at the same time that average returns seem to change. Now, this gets to the kind of the weird part about recession risk. If you asked me what should I do about the recession coming up, I wouldn't say to disinvest from stocks.
Really?
That time has already passed. By the time you get information, remember what I was saying about high frequency traders? By the time information comes out, it's too late for you to act on that information in a way that's somehow going to beat the market. And that is equally true now. So we've seen prices fall. Prices, you can look at price dividend ratios. You can look at just the S&P 500 index. It's fallen significantly since 2 weeks ago. Where it ended up today, I haven't checked.
Down a
1,000 points.
Yeah, so it counteracts yesterday.
Not a good day.
Not a good day. But there's a strong logic of equilibrium in economics and finance. So what's equilibrium mean here? Prices are set so that investors are indifferent between keeping their money in and taking it out for the typical investor. Mechanically, that must be true because every share that's out there is held. Someone owns all those shares of Walmart, Google, etc. So prices are set so that people are, well, I know there's a lot of risk, but I'm kind of on the fence. So how do you become comfortable with taking on more risk than we had a month ago? Well, the average return to stocks actually probably has gone up. Now, what's the logic there? That sounds crazy. Like we're seeing a string of negative returns. How can you tell me that the average return going forward is probably higher than it was? Well, think about it like this. Your first impulse is sell, sell, sell. And that's a normal human impulse. We are seeing risks that we don't necessarily understand. Maybe our aversion to risk is changing. So in general, I hate what's happening in financial markets because I am really concerned about this and what's going to happen to my personal wealth in ways that are totally outside my control. So what do financial markets need to do in order to keep me from selling? Because if everyone sells, that means that, well, someone else must be buying.
Yes.
So to prevent me from selling, it must compensate me in some way. How? Average returns go up. So risk goes up, average returns go up. How do average returns go up? The price today falls. It's the weirdest thing. It's like this backwards logic in finance. The way that average returns change is you look at a return now, you look at the price today and the price in the future that's expected. So the return is the difference between those things. Financial folks think of that price in the future as fixed. It's just there. So if you want to make that difference between the price today and the price in the future change, you adjust the price today. That's what's under control of financial markets. So to make the return higher, the price today falls. So price today has fallen dramatically over 2 weeks. Expected future returns are just high enough to compensate the typical investor for the additional risk they are taking now.
By staying in.
Wow. There's some kind of like psychology or design to this?
Well, no, the reason there's a famous quote that Warren Buffett quoted and Bezos also quotes in his public communications, which is that over the short term, the market is a voting machine, but over the long term, it's a weighing machine. You probably know the original for that, or chat will know the original guy who said it. But what it means is that long-term equities are valued for the value of the underlying corporation and the business it does. And so, except to the degree that a recession or other macroeconomic event changes the value of the company, eventually, over the long term, the valuation of that equity will return to the valuation of the enterprise.
Doesn't that assume that the enterprise itself is continuing to create value?
Yeah. So
yeah, it does.
Yeah.
I said
Ethan,
that.
what you're talking about is there's kind of this mean reversion over a long term in financial markets. And that
sounds
true.
So elegant. Mean reversion.
So
I got
what does that mean?
Yeah.
You've got bad times. They tend to be followed, at least over a while, by abnormally good times. Returns get high to compensate for the bad times.
Yes.
So if you're holding stocks, it makes sense to hold them for long periods of time because mean reversion is a thing for stocks. It's not for every asset. And long periods can be 5+ years. But you do have that property that makes sense to just think about, well, what's long-term value? What's long-term being created by companies? But this other thing is almost more primitive, this idea of equilibrium.
Okay.
So think of two forces. There's a force that is good, average returns. There's a force that's bad, risk. Now, if everyone's forced to hold the aggregate market, so on average, we're all holding the market. So if everyone's forced to hold that same thing and one force gets stronger, then the only way that we're okay holding that same thing is if the other force gets stronger as well. So the only way we can remain indifferent between holding stocks and not holding stocks when risk goes up is as average return goes up. That's the only way that can happen.
Or now, irrational behavior.
So irrational behavior can be a part of it. And what that leads to is a lot of churn. So there are some investors that sell and it becomes a reallocation between those who are willing to absorb the risk and those who aren't, those who react strongly to a change and those who don't. But on average, what must be true is if risk goes up for the aggregate market, the average return goes up as well.
Wow. That's so nuts. Is there some kind of underlying value to all of this, to the whole market? Or is it literally just like the psychology of the, like,
it's like GDP or something?
Is the price like, is the price, can you actually, with your understanding, can you actually point the current valuation of the markets and the current valuation of like some of these individual companies back to fundamentals? Or is it all just variable based on like people's demand and shit?
You hope it's linked to fundamentals.
Yeah.
But it's very hard to go from a balance sheet into the average returns of a stock. It's very hard. So most finance folks don't look so much. There are fundamental investors, but at least quant finance folks and academic finance folks, they give up on getting the price exactly right and the future price exactly right. Instead, they look at, well, what are the risk attributes of a company? And based on those risk attributes, what should I expect as compensation for taking on that risk?
When you say risk attributes, what do you mean?
Yeah. So I don't know what Microsoft should be worth, but I can go to Yahoo Finance or Google Finance or what have you, and I can look up the beta or how much Microsoft stock responds when the aggregate market moves up or down.
Interesting. Okay.
So I can look at its beta. I can look at how it responds to all sorts of other risks and say, well, Microsoft has this much risk. This is the typical compensation in terms of average returns for that sort of risk. And that gives me a prediction for how much Microsoft should deliver to me if I invest in it in terms of average returns. Now, where the price is set, I have no idea. That should be linked to fundamentals in some way. And the fundamentals also are tethered to risk.
Mm-hmm.
But for much of what I do, as speaking as a former academic, and much as what quants do, they don't pay much attention to fundamentals, period.
Okay. And can you make sense of this in some insane way? Do you put order to this chaos in some way with your understanding of this?
So the order is to think about what I care about as an investor. Do I care about the actual price of the stocks in which I invest? Probably not. I care about, if I invest today, what's it going to do for me in the future? So if Microsoft is 100 or 1,000, that dictates how many shares I have of Microsoft.
Yeah.
But doesn't tell me what the return on my investment is. And that's what matters to me.
Great answer.
Yeah. So Zoom's going to blow up on us again in a minute, 4 minutes. But I guess one thing that you haven't talked about much, and I'll lead the witness a little bit, is buying and holding long term. Like, a lot of chat is basically talking about if you just hold long term, many of these problems go away. You've said a little bit about that, but
hold on 1 sec.
Yeah.
Chat, I didn't know that Zoom did this before. I've always had calls with 2 people. Okay, you chill. All right. You got like people were like CEO Andy freaking not even spending $15 for Zoom. I didn't fucking know, dude. Holy shit. Okay, I'm sorry. Go ahead.
That's good. No,
Yeah.
F them.
Right. Yeah.
Okay, everybody together. Screw Devin's bitchy chat. There, done.
Okay.
No, we'll fix it.
Next show will be better. Okay, I promise. I love you.
Yes.
Thanks.
There is no way we will inflict this on our next professor guest on Monday. So
see how Ethan feels about you guys? I love you. Don't worry.
Eggplants in chat on Devin's stream. You can do them here too, because I know we all overlap. All right.
So your question was about buy and hold investment.
Buy and hold.
Yeah.
Buy and hold is a very reasonable thing to do. There's something that I linked to, I think, very early in the stream, but it's an old paper from about 20 years ago. The catchy version of the title is Trading is Hazardous to Your Wealth. So the idea being, you looked at individual traders' accounts. So he had data from Schwab. It's not mentioned in the paper where it's from. A different story there. Mm-hmm. And the guy looks at individual trading accounts and says, okay, who's doing well and who's doing less well? So what you kind of expect is that the people who are trading a lot are sophisticated. These are people who have some sense of how the markets are going. They understand the flow. They get the information. And while it's true that they perform slightly better before fees than those who don't trade at all, after fees, they perform much, much worse. So when you trade a lot, it's possible you're responding to some information, and maybe you're right slightly more often than you're wrong, and that's the whole value prop for HFTs, like 50.01%. You're right, but the trading costs tend to eat up those gains. Mm-hmm. So buy and hold is a great strategy for ensuring that your trading costs are not out of control and eating up your wealth. Now, when I think of other reasons for buy and hold, well, you've got mean reversion, which I just mentioned. Bad periods tend to be followed by abnormally good periods in stocks. It relieves you of the mental cost of seeing losses. So doesn't trigger a loss aversion. But there are still some guardrails you should apply. So, for example, for buy and hold, if I stayed within Vanguard's mix and were adapting it myself, 90% stocks, 10% bonds, eventually that's going to become 95% stocks, 5% bonds. So I have to rebalance.
Portfolio rebalancing.
Yeah, so you have to do a little bit of changing on the margins. But broadly, when you have a long-term investment objective, it's good advice to be a buy and hold investor for most people.
Sweet.
Wow.
All right.
Cool. I think I'm about to drop again.
Yeah,
we are, but I think I wanted to do one more segment, so maybe we just do one quick reinvite.
Yeah, bring it, and then we'll wrap up.
Okay, we're gonna do one quick reinvite because I want to do takeaways. All right, 1 second.
All right,
I'm gonna end this.
All right, we'll go back. We'll do one more. We'll talk about the stream on Monday, which is going to be incredible, also, and then we'll wrap up. But Monday, I know you've all heard it 5 times. Ligerbox, who's here. Liger, if you want to talk in chat about the incredible guest we have coming, tell people who we have coming Monday morning at 9. It's just so amazing, and we're gonna talk coronavirus with a virus expert. So, and I'm really looking forward to that. And I have Liger to thank for it. And this community is great. The people you bring, the people you know.
I think, is Brian here? Yeah. I think one of the really, really big things is like, I've written out a list. That list I'll put it on Discord. But I also want some of the most important takeaways you might have for people going forward. There's a lot of impressionable people here that are going to be, entering their financial life or already in it and want to know what to do. What are some of the big things that you think that they should consider in the context of like what we've been talking about for this entire time? Or just your own stuff, whatever you know.
Yeah, so we started off with this was a personal finance stream. So the most obvious advice is not the most sophisticated one. It's just a simple save. Like carve out some fraction of your income and save and dedicate yourself to it. Have some sort of tracker to help you, a budget tracker, a finance tracker, something like Mint. Set goals and track toward them. I mean, this is not rocket science. You don't need a professor to tell you this, but that has by and far the biggest single thing you should take away from this stream, if you're not already doing that. Beyond that, I would say number 2 is passive managed index funds are great. They're
ETF.
So again, there's differences in tax treatment. So ETF, there are good reasons to do that relative to passive mutual funds. But the first order thing there is you want something that's cheap to invest in rather than an active mutual fund, which might take off 1% per year. And you want something that's well diversified so that you're compensated for the risk that you take. If you're taking a risk, it's important to be paid back for it. And when you invest in individual stock, a lot of that risk, a lot of that volatility, you're not being paid for in terms of changes in your average returns. We talked a little bit about market timing in general. Doesn't pay off for individuals because we don't have access to the signals required to make that work. Now, of course, if you had a crystal ball, terrific, but most of us don't. So by the time information comes out, there's some algorithm that has processed that information and incorporated into prices faster than you can blink. This is not an overstatement. So market timing is really hard to do based on short-term information. For long-term information, it is possible but challenging and out of reach for most of us. And we talked a little bit about equilibrium in the context of the recession, which may or may not come. But certainly there's been a market disruption. And the Fed has seen they have private information. So they see a need to change interest rates. So that in itself actually told the market, actually things are potentially bad. So that was initially not reassuring. Markets did not respond well initially to the Fed because what that told them was actually times are potentially worse than you think. But in a recession or entering into one, average returns change in a way that compensates the typical investor for increases in risk. So these are good opportunities to evaluate your individual risk tolerance, but whether you should buy or sell, the typical investor should not change their portfolio unless there are urgent consumption needs that are not met if stocks perform badly. We've already talked about diversification and stock picking, and probably the last advice would be thinking about rent versus own and general philosophy of what sorts of investments to think hard about. So think about the biggest risks, spend a lot of time with financial calculators. Most of these tools are freely available to manage those risks well. Auto loans are another example. What do you want to do? And then for a lot of smaller risks, don't spend your mental energy. It gets exhausting. And that means probably don't watch CNBC every day unless that's how you have fun.
So when you thank you for all of those. When you talked about, one thing we didn't talk about is having enough cash buffer to get through a crisis. In other words, the worst situation for almost anyone is to be forced into very uneconomic short-term circumstances. Because when you run out of options, and this is true in business as well as in personal life, like payday loans are the most expensive loans. They're even more expensive than credit cards. Having your car repossessed is the worst missed car payment. And in the business world, this is like taking out a bridge loan or something between investment rounds. Basically, I'm probably doing a bad job of explaining this, but when you need money at any price, that's exactly what you'll get. You'll get money at any price.
Yes. And that applies in financial markets as well. And I've been looking at chat from time to time. People say things like, oh, put a stop loss order in there. And I'm speaking exactly to the people who know what that is. Stop loss orders are really expensive. And you see that sometimes during these little flash crashes. It clears out a lot of people who sell at any price, and they don't necessarily make that money back. I saw this internally at the CFTC. Unfortunately, this happens even to institutional investors as well. So markets will give you investments as long as you're willing to pay infinitely much for them. But sometimes things that look relatively safe actually aren't.
All right. So Devin, you good?
Dude, Brian, you're a gem. Really. I mean, the amount of value that you provided in this amount of time, and it's just, I cannot tell you enough how many people you impacted positively by coming on here and doing this today for Ethan and I. And we both really appreciate it.
Yeah, completely.
Really
it was also fun to have Think Banhammer come in here. That is Brian Weller, who's director of data science for Twitch. So it's like this, I don't know, triple double where we have a community member and a fan who's also got all this expertise that he shared from his academic history at Duke, and also is a member of staff at Twitch. So super awesome.
Dude, Twitch is about a lot of things, and you know that working there, both of you. But the fact that this kind of stuff can happen on Twitch and that people can actually receive it is literally one of the coolest things. In 2020, I could never imagine that I could sit here for hundreds of people and have this happen. And so, like, speaking on behalf of my community as well, thank you both, because Ethan, you were the person who brought Brian into this world for us. And Brian, thank you for being, I know you guys are separate from Twitch in your opinions and everything. The fact of the matter is that you want to use the platform that you work on every day to make a positive impact on the world is incredibly inspiring. And I am, it's just so meaningful to me that you guys are helping make this happen. Like, thank you so much for putting this content out there, because that is what this platform should be about, adding value to people in these ways. It is awesome. Thank you.
Yep.
Awesome. Thanks for having me, guys.
Devin and I, and Brian was a part of this as well. We're glad to have had you here. But we're going to be back doing this bigger, better, faster on Monday, because we will have a professor of virology from Columbia University on at 9 a.m. Monday. Devin's going to get up in the pre-dawn darkness and trudge across Redmond, unhappy and swigging green tea, hoping for awareness. And we're gonna get Dr. Racaniello on. And he's going to talk I've never met him, but Liger introduced me. We've talked through email some. He's going to talk about coronavirus, and he actually knows. He's been studying these viruses for 40 years. He is a true boomer. He's a virus boomer, a boomer virus. I don't know, but we're going to have a chance to talk about the hottest possible topic right now, because, my, all of King County, and now I hear all of Washington State is work from home. And it's going to be more of us soon, I think. Like, no
Brian,
special.
Any way we can people can find you? A lot of people are asking.
Nah, this is my first time ever streaming.
Do you want to be found? Like Twitter or anything like that? You don't have to be found.
I don't have much online presence. I mean,
I like that style, buddy.
You can link me up on LinkedIn, but other than that,
there is a place to find him, though. He hangs out. Do you watch Devin as well? Or I know you hang out in my
he
chat.
does. Yeah. I didn't know it was him.
To time.
I didn't know it was him. Now I know that when I'm freaking out and he posts something, like, I'm like screaming my ass off at something. He posts something. And I'm like, that's him.
So the place to find him is Think Banhammer in chat. Yeah. So he watches us both when he gets the chance. So come on back to Devin's channel, my channel. We'll eventually be allowed to go back out in public. When the great virus, those who live will be allowed to reclaim the ruins of the world.
Yeah,
that's right. Average returns are high for the survivors, guys.
Oh, there we go. The financial lesson ties to the virus lesson. See, you can just you can claim the empty houses. Yeah, it's all there.
Yeah.
All right.
Have a good night.
Yeah,
all right,
guys, thank you so much. Really appreciate it. Ethan, we'll catch up later.
Yeah, probably. We'll talk about how to handle Monday. Cheers, man.
Yeah, you got it, man. Love you, man. I will see you. I'll talk to you soon.
Yep. Bye.
Bye.
All right. Leave meeting. We're out of there. All right, everybody. Well, that was a hell of a stream. I hope you enjoyed it. Hi, I'm Ethan Evans. I hope you've gotten a lot out of this show. To follow us on YouTube, please click the bell icon in the bottom left and subscribe. Also, you can find us live on Twitch, where we answer questions interactively. Further, we have a Discord community, where not only I, but other members of the community team up to answer your questions interactively. Hope you've enjoyed. Thank you.